Is this going to be the end of the gold bull run? Is global liquidity going to work against or with precious metals? Are we going to see a new 60-40 portfolio? I have a bunch of questions. Luckily for you, I'm not answering any of those questions because I have Michael Howell here with me. Michael, I don't think you need an introduction. Actually, I might need an introduction because most people watching will know you, but not me. Luckily for them, I'm irrelevant. But what's not irrelevant is again global liquidity, which is the title of pretty much every interview you get on. Because as far as I understand it, over at Cross Border Capital, you look at global liquidity, essentially the flow of money around the globe between central banks and in between markets and whatnot. And then you make investment decisions based on that. You don't actively manage portfolios within equity, but you advise. And anyways, I think the reasoning behind why you do that has been well covered. Feel free to update me on it if you want. But instead, I really want to talk about where that strategy has brought you today. And I want to understand what you're like if you did manage money actively, what would a portfolio look like in terms of exposure to each asset class?
Okay, well, thanks. Great to be here. Let me just give a brief outline of why I'm sitting here, and maybe why global liquidity is important, and then we can put this in the context of the cycle. Global liquidity was a concept that was basically devised back around the mid-1980s when I worked for the US investment bank Salomon Brothers, and it was really a recognition of the fact that markets were becoming international. And money, in other words, capital flows in this case, were very fungible. They were swinging between continents, between markets. They were moving very rapidly. And Salomon Brothers' whole philosophy was really trying to understand trading flows. And they were the biggest market in bonds. They were the bond market pretty much in those days. And to understand how bond markets were moving, you really need to understand where these money flows were doing. And what we did from the research in the research department was to try and calibrate the whole concept of liquidity and global liquidity and understand how that moved markets. Now, there were two conclusions really that came out of that. One is that it's very cyclical, and secondly, that that cycle tends to have a fairly set frequency. It tends to be around about 5 to 6 years. Now, it's important to understand why you've got a 5 to 6 year cycle, and maybe why that's different from the traditional notion of a 10-year business cycle that you kind of read about in economics textbooks. And part of the reason for that is the whole nature of the financial markets has changed really over the last 2 to 3 decades. And if you look back, maybe to when I started, or maybe prior to when I started in financial markets, it was very clear that what was driving the business cycle was capital spending, and interest rate movements by policymakers attenuated the capital spending decisions, and that really moved the whole business cycle and caused economies to expand and contract as a result. The problem is that there's not a huge amount of capital spending going on right now, particularly in the West. We've got mature economies. Most of the capital spending that we see worldwide is undertaken by China, which is a state-run planned economy. It's not going through the market, so interest rate decisions are kind of secondary. And what we see in the West is this huge buildup of debt, which overhangs markets. And the 5 to 6 year cycle is really a debt refinancing cycle. So the average maturity of debt out there is about 5 years. And you've currently got something like $350 trillion of debt with a 5 year maturity. So that says you've got $70 trillion of debt on average to finance each year. And that's what financial markets are about. They're big debt refinancing mechanisms that absorb lots of liquidity. And that liquidity tends to move in a 5 year cycle, which is the cycle that we see out there moving markets. So basically, that's why we look at liquidity. That's why it's important. In many cases, we think this is the most important factor, and it's certainly a lot more important than interest rates. I think, as anyone will attest, over the last 5 years that have lived through COVID, etc., or even go back to 2008 with the global financial crisis. It's all about money flow.
Let's pretend for a second that I understand all of that to make me look good on camera. Where would I put my, like, if I gave you $1 million and I said, Michael, you have to, I wish I had $1 million to give you, but you have to deploy that for me. How do you split it?
Well, I think the first thing to say is that the first question that we always ask people is, what is your investment horizon? Okay. Clearly, if you've got a very short-term investment horizon, you're only talking about 1 or 2 years. The asset allocation that you would take is going to be very different if you said, I want to invest over a 20-year or 10 or 20-year period. And I think what I'm really saying here is you've got to differentiate the trend from the cycle. Now, in terms of what's driving the cycle, I said there's a repeating 5 to 6 year liquidity cycle that maybe people can accept. But really, on top of that, there's a trend, and it's the trend that is probably the most important thing that we need to understand right now, because the nature of that trend has changed. And the reason that the trend has changed is we're moving into an era now that many people will kind of dub fiscal dominance. And what that really means is that central banks and maybe the banking system generally are slaves to what governments need in terms of funding their budget deficits. And the only way that we can think of at least, that governments actually manage to fund themselves is by printing money. And we've got to the stage where it's just really, really difficult. And you can think of this in the context of the US presidential elections coming up, that you've got fiscal demands, mandatory spending demands that are coming through from Social Security, Medicare, as populations age. You've got the defense bill to pay, all this stuff. I mean, who is going to stand up and say, we're going to cut that spending? Nobody. The amount of discretionary spending that Biden or Trump will have is de minimis in many cases looking forward. It's all mandatory. It's all pretty much set in stone. And that trend is rising. What they do have discretion about is the taxation element. Now, which of those presidential candidates is saying they're going to raise taxes? None. They're more likely to say they're going to cut taxes, okay, or they're going to keep the current tax cuts running for longer, whatever it means. They don't want to raise taxes. So you've got a whopping great deficit to fund, and that is clear from. If you look at the Congressional Budget Office, which is a bipartisan body, as you know, which does these calculations, it's very clear there's a gap. That gap has to be funded, and that will be funded by printing money in some way. That is monetary inflation. If we're in an era of monetary inflation, in other words, fiscal dominance causes monetary inflation, you've got to invest very differently than if we're in the, let's call it the previous regime that was characterized by tough central bankers, that was brought in by Paul Volcker back in 1978, when he came in, hiked US rates, and really throttled inflation out of the system. That was a period that you might, in contrast, call monetary dominance. In that era of monetary dominance, you had fiscal discipline. You had central banks that were not boosting, growth willy-nilly. They had an organized and robust monetary policy, and inflation was basically low and contained for a long time. That environment of monetary dominance, as I called it, was fantastic for a 60-40 asset allocation of equities 60%, bonds 40, and probably nothing in gold, or certainly nothing in crypto, because that wasn't around for most of the period. But that wouldn't be around. That was different to what we'd seen before. In the 1970s, during the high inflation era, gold took up a very large component of investors' portfolios. I mean, I can remember, even when I began in the industry in the mid 80s, what you saw was a lot of European banks, particularly Swiss banks, still had 15, 20% of their client portfolios in gold. Okay. Now that very quickly came down to probably nothing, but it's on the way up again. So what I'm really saying here is that if you're in an environment of monetary dominance, a 60-40 bond equity allocation, 60 equity, 40 bonds, that bond equity allocation makes a lot of sense. If you're in a period of fiscal dominance and monetary inflation, then you want a very different asset mix. You certainly do not want a heavy bond portfolio. You want to get bond duration out. You want to think maybe of holding more cash, not having long duration or long maturity treasuries, and you want to think about replacing them with assets like gold or real assets that will basically perform well in a period of monetary inflation. And monetary inflation is what we've got, and it's already starting.
I often joke about this, but it seems like bonds only go down, and now you're giving me the reason to actually believe my jokes there, because it has been the case, and this seems like the end of the 60-40 portfolio indeed, as we used to know it. But given the state of the global economic system, which is to say the fact that we now live in a debt-based economy with interest payments that have to be refinanced, as you just pointed out, with more debt. And so creating a virtuous cycle of debt, really. Doesn't that make you bullish on gold kind of in perpetuity? Do we make the new 60-40 portfolio 60 equity or 60 gold and 40 equity?
I think it makes me a lot more positive on gold. Absolutely right. I mean, I would be the first to say that. I think it also makes me optimistic about crypto, particularly Bitcoin, because I think those are maybe the modern generation's equivalent of gold. And I mean, I've talked loosely before about maybe Bitcoin being exponential gold because it certainly behaves like that in terms of its performance vis-a-vis liquidity. It's proven in the last 5 to 6 years to be a wonderful barometer of the liquidity available in markets. So if there's lots of liquidity, Bitcoin shoots up. If liquidity gets tough, Bitcoin clearly comes down very quickly, and it's almost immediate indicator. So I'd certainly consider that too if you believe what I'm saying as to be a risk. I think the thing that we've got to be wary about is we've been here before, and we know that governments don't give in easily, and they've got to sell their debt. And in many cases, they're pulling most of the levers or holding most of the levers here. And we've got to be wary about that. So, one of the things to think about is what happened in 1934 with the Gold Act. And then it was basically a clear case that holding gold, if you're a private sector individual, was impossible. It became illegal. You got whacked with a whopping great jail sentence and a huge, huge fine. So much so you certainly wouldn't even think about wouldn't contemplate holding gold. You'd hand it back to the Treasury, and that's what happened. So that was one way that the government's tried to demonetize gold. It was successful for a long time, but I would say they've now failed because a lot of people now use gold as a monetary asset. And clearly, if you look outside of the US and the West, other nations like China and Russia are starting to use gold more and more as a monetary instrument. They're accumulating gold very fast. If, for example, you calibrate the amount of gold holdings by the BRIC economies and their friends, so-called friends who want to join that BRICS club, it now surpasses the amount of gold held in Fort Knox as of the beginning of this year for the first time ever. So that's how trends are changing. So gold is becoming an asset in demand. And if you look at the demand equation from the world private sector alongside the lack of supply, because governments outside of the West are accumulating, then you've got the recipe for rising prices in the medium term. So I think absolutely yes. Do you want to put all your eggs in the gold basket? Probably not, because of the reasons that I said. Look at the risk of some sort of legislation against gold, making it impossible to hold it or very difficult. And the other thing we've got to remember is that governments still want to sell their debt and they still have an interest rate weapon. And I certainly would not rule out in the next 12 months, or maybe, yeah, let's say the next 12 months or 12, 18 months, let's think about the Federal Reserve hiking interest rates aggressively to try and force people back into the bond market for the simple reason they've got to discipline investors. They've got to get this sort of speculative or investment fever out of people's minds, and they've got to try and push them back into their own assets, which are government bonds. So the cynic in me says, let's never rule out the fact that governments there's a sting in the tail here. We've got to be cognizant of that. So you want to diversify, you want to have an eye to what's going on. But my view would be for the next 6 to 9 months, it's a pretty much plain sailing route. I think liquidity's got to go higher in the period up to the election, certainly up to the election and probably beyond, because I can't believe that the Treasury and Janet wants to risk any accidents before the election. And I think they've got to keep markets liquid.
How long of a cycle do you expect this to be? Because we kind of seem to be in the first innings, the beginning of that cycle, maybe. So how long is it going to continue on for?
Well, I think you've got to differentiate the liquidity or investment cycle from the business cycle. I think those are two very different things. I think the business cycle is more likely to peak out sometime in 2026. So I think we've got quite a long run for that. And my view would be, which may be a controversial view, is we're kind of in the early stages of the business cycle. I think there's a lot of distortions going on top, which makes it hard to read. One of them is the big fiscal spending boost that we saw, over the last 18 months. The CARES Act, etc. And the other thing, of course, is what the Chinese economy is doing, because the Chinese economy, in many cases, is the elephant in the room when it comes to the global economy. And China, for various reasons, has actually put the monetary brakes on of late, and the Chinese economy is stuttering, to say the least. And that is pulling down world growth, and it's having an adverse effect on commodity markets right now. But I don't think that's going to last very long. And I would suspect that the Chinese are going to start to throw a lot more money at their economy over the course of the next 12 months or so. So I think these things have got to be taken into account. But I would say the cycle looks to me early cycle. I think the yield curve, which is inverted, is going to start to steepen quite aggressively. And that is normally a precursor to a stronger domestic and world economy. I think that's the way we're going. So 2026, I would argue, is when you see the business cycle peaking. And I think in terms of the liquidity investment cycle, our view has been sometime in late 2025, about a year ahead of that. But that's quite normal. That's what you'd expect to see. Financial markets always lead real economies.
With the business cycle peaking, does that make you, do you think that's going to introduce fear into the system and therefore still put, upward pressure on gold?
Well, I think the my view is that what really drives gold is not so much the uncertainty factor. I mean, I think there's a people have looked at gold and they've tried to factor in geopolitical risk, high street inflation, and whatever. In all the work we do, what seems to come out very strongly is monetary inflation. I mean, gold is a monetary standard. It's really the benchmark. It's the historic benchmark that many people have used. If you look at the names of currencies, it all goes back to sort of weights of precious metals. A pound of sterling silver, for example. All these examples, and basically, what I would argue is that it's that monetary debasement that really is driving the gold price up. Or to be absolutely strict about this, in truth, it's not the gold price going up, it's everything else going down. That's really the proper way to see it. So we always think about the gold price rising, but in actual fact, gold is like the pole star for navigators. It's the fixed point in the heavens, and paper money tends to devalue against that. So it's not really gold going up, it's everything else coming down, is the proper way to look at it. It's the devaluation of paper assets. And the question is, do we expect that in the medium term? Sure, we do, because I think the only way that governments can afford the commitments they're making is by basically printing money.
So, like Lynn Alden likes to say, nothing stops the strain. But somehow that liquidity hasn't found its way into the gold equities, though. Why do you think that is? And maybe more importantly, for selfish purposes, what do you think changes that?
Well, I think it may just be a question of, I think there's a number of answers, and I'm not going to say I've got the definitive ones, but I think one is a question of time. I mean, what we've really only seen are the early stages of a gold rally, and gold is moving uncertainly right now. And part of that is that I would imagine that what you've got is a lot of shorting going on from the bullion banks. I mean, that's not untypical behavior. And so what you see is that gold tends to move in quite sharp steps. And it may not be the first step that really enlivens the miners. You may need one or two steps before they really get going. But what we do know is that once the gold price goes up, there is enormous leverage in the profitability of these counters. So I think it's well worth contemplating, if you want gold equities, to actually think about that sector of the market. I think you've also got another factor which is coming in, which is going back to the Bitcoin phenomenon. Whereas my generation was very keen on buying gold, your generation is probably keener on buying Bitcoin. And that's just a question of taste, as far as I can see. Maybe younger people understand the technology and the opportunities of crypto and Bitcoin rather better than older generations like mine. But we fully understand the whole principle behind monetary inflation and monetary inflation hedges, which gold has always been sort of top of the list for many people throughout history.
Yeah. Bitcoin, yes. Crypto, not so much. Speaking out of experience
Right.
myself. But then again, I'm also attracted to junior mining, so there's probably something wrong with me. Do you think when you say that we're going to have to see gold move first and then the equities, that means that somewhere in between there's going to have to be a switch of the flows of capital, and potentially to push those gold equities up, we're going to need more firing power than what retail investors have. So do you think the institutional capital is ever going back into the gold business to match the levels of, say, the 2000s commodity bull market?
Well, I mean, the answer is yes, but it's a complicated yes because I think the parameters of the market have changed quite a lot, and what I mean by that is that if you look at how the market is structured right now, there's a clear dominance of index funds, either directly or indirectly. And I'm thinking here of the growth of 401k plans and things that are what are they called target age funds which are basically, quasi passive instruments or indexed instruments. Now, what that really plays on is momentum. So, Mag 7 didn't start out as Mag 7. Mag 7 got big because more and more people bought it. And as the price rose, more and more people wanted to buy. And so I think you've got that momentum factor that you need to factor in. So gold equities are a small part of the index, minuscule probably right now, but they could get a lot bigger once you get the momentum going in. So I think there's a question of understanding that structure. I think the other thing, which is partly associated with that, is that a lot of institutional investors are not selling asset allocation anymore. What they're selling are products, right? And what I mean by that is there are fewer balanced funds and there are more specialist funds. So in other words, people can go and buy a tech fund, they can buy I don't know, a crypto fund, they can buy an energy fund, they can buy a commodity fund. Okay, whereas before that was wrapped up in a balanced fund structure, and maybe there was more discretion for the investment managers, the professional investors to say, we want to allocate more to mining or we want to allocate more to gold, okay, in that dimension. Now you've got to rely on the advisors or the actual retail investors themselves, who again, that's a momentum phenomenon. So I think what I'm saying in all this is that it'll come, but it may take longer than you would expect normally. But then maybe the upside, just looking back at what happened to Mag 7, is greater because you'll get the overshoot.
What that then makes me think is what happens to what happens in between? Like this kind of sounds like a chicken or the egg type of situation. Is it may be a bottleneck because you say momentum is going to attract maybe some of the passive funds to come into gold, but what's going to attract momentum to begin with? And is it up to us retail investors to get excited about gold and blindly, unfortunately, start buying these equities? So yeah, I mean, what comes first, chicken or the egg?
Well, I think you've always, I mean, my view about investment is you haven't got to think about the current, you've got to try and think about what's going on 12 months out. And let's think of the economic landscape, this time next year. What is it going to be like? There'll be a new president. There'll probably be, I would imagine a stronger economy. My view would be inflation will be stickier. I think the Federal Reserve will have 2 or 3 interest rate cuts behind it already. And I think there'll be, maybe a more buoyant outlook. And, hopefully with elections out of the way, you'll have a geopolitical landscape worldwide, which at least looks more understandable, let's say, rather than more manageable, at least more understandable. So all those factors would basically suggest that financial assets will be higher this time next year. And I would suspect as well that you will have more evidence of central banks being strained with fiscal balances, okay? And they're going to have to more explicitly print money. And that will just fuel this whole idea behind more inflation. We've already seen with the US presidential debates, or certainly the wake of the presidential debates, concerns in the treasury market that if Trump is the ultimate victor, his program is unambiguously inflationary. And what you've seen is the treasury market selling off on that concern. Now, what we didn't see is a follow through, at least in the gold market, from that. And that would be clearly a natural corollary. If you look forward. Now, this is, one swallow doesn't make a summer, as they say. So we got to look at a series of these. But I would say that's the sort of environment I would suggest. Now, what would make me a lot more negative on gold is a situation that probably suggested there could be a liquidity crisis where basically all assets will sell off, or you start to see that backdrop of much higher interest rates, where the Federal Reserve is starting to hike rates significantly again. And that would basically detract from gold. And I don't see that on that time horizon. I'm saying it's not maybe further out, maybe another year, you could see the Federal Reserve coming back. But I would say, looking at the time horizon now, you've got the ability for gold to move up. And it's the trend that I keep emphasizing that's the important thing. If the Federal Reserve does tighten at the end of next year, as I think may be a risk, then that's a wonderful opportunity to go back in the market and buy more, because I think the trend is unquestionably going upwards. I think things have changed. I mean, if you look at the trend in bond markets for bond yields, you've seen bond yields in many markets break 20 or 30-year downtrends. Okay, and maybe that uptrend is not definitive yet in the US Treasury market, but it seems to be definitive in leading markets like the Japanese government bond market, which was the first into the disinflation, and it may be first into a monetary inflation. So I
Hmm.
think all these things are, worthwhile looking at. We live, after all, in a global world, not a local world.
Michael, are you telling me that Japan is not going to take over the US? I don't want to hear that.
I don't think there's any way that's going to happen. If it
No, I
was,
know it's kind of been it was speculated on. It was kind of a big topic for a short period of time that I thought was kind of silly there for a second. But jokes aside, the activity of central banks buying of U.S. treasuries and their buying of gold has been a big influence on both markets, it seems, over the last couple of years. Do you see that continuing in the same fashion that it has been going over the last 2 years?
yes, I mean, unquestionably, yes. I mean, there's no way around that, because what you've got, I mean, the great paradox that you've got in the world right now is that China's trade surplus is bulging. Okay? It's getting bigger and bigger and bigger. Now, that may be by dint of the fact that the Chinese economy is slowing down, so imports are slowing while exports are still holding up. But you've still got this whopping great trade surplus. Now, the question the Chinese have got is, how do they deploy that? Now, one of the things you've got to remember is that the bulk of that trade surplus is either directly or indirectly dollar based. Okay, so I'm not saying that they invoice everything in dollars, but they still invoice a lot in dollars. And the bits they don't denominate in dollars, so they denominate or invoice in yuan, are probably ultimately converted back into dollars by the recipients, mainly OPEC or Saudi Arabia or whatever. Okay, so they don't hold yuan, they hold dollars. So at the end of the day, what China is basically doing here is they are holding a whopping great dollar-based surplus. Now, where are they going to put that? Now, they'll want to avoid US financial assets as far as they can. One would imagine, right? We don't know how the Chinese are thinking, but one would imagine that's what common sense would say, given what happened to Russia. So they won't want to put it directly in treasuries. But the trouble is they have to, because there's nowhere else to put it. They can try and channel money into gold, okay, but the gold market simply isn't big enough. So if you want one driver of the gold price in the medium term, think foreign governments who are alien to Western politics. So you think of Russia, China, North Korea, Iran, exactly the usual culprits. And you think of those countries that are very close to that group or that BRICS grouping, and then you've got others to throw in. Central Asia are accumulating a lot of gold right now. So these are the countries that are buying it up, and they're putting their assets there rather than US Treasury bonds. And that's where the marginal dollar of reserves used to go, but it's now increasingly going into gold. And that is bound to push the gold market up, because the gold market's not big enough to take these flows.
I think the Chinese should listen to this to my podcast, and they would know that the bond market only goes down and gold only goes up, and that way they're going to stay on the right side of history. Uh, but again, you bring up an interesting point here, Michael, that's got me thinking about the dollar's share of global transactions as a whole, which has been, for some reason, a controversial point of discussion oftentimes. What's your research telling you about the current state of the dollar as the world's reserve currency? Maybe more importantly, the future of that status.
I think the future is intact and looking pretty good, in my view. I
Mm.
think that there's a lot of misspeaking about the dollar. I think too many people, particularly Europeans, want to write it off, all too quickly. But my point is, and continues to be, that we've still very much got the architecture of Bretton Woods in front of us. Okay, the Bretton Woods financial the International Monetary System as set up by Bretton Woods in 1944 is still there. You've still got the dollar at the center. You've still got the IMF and the World Bank policing the system. The only thing you don't have is fixed exchange rates. But that was never an integral part of Bretton Woods anyway. We've got floating rates, but actually, ironically, floating rates have increased the dominance of the dollar rather than decreased it. And I think that's the critical thing to think about. So where we are now, we're living in a world where the dollar is still the dominant currency. What other currency would you lend and borrow in? I can't think of one really. And so the dollar is by default the major currency. And I don't think there's any way that any country can really get off the hook of the dollar. Let's think of China and let's be realistic about China. China is sitting on, a vast economy with lots of wealth, but it's got capital controls. If they took those capital controls off, would capital go in or would it come out? It would come out in huge size. We know that. There's probably a leaking capital account already, which is one of the reasons that the Chinese yuan is depreciating in value because people want to get their assets out of China. Okay, so this is the reality. The only viable alternative to the dollar is the Chinese yuan, and that is not a particularly good, currency to think about. So the dollar is going to remain preeminent, in my view. There clearly will be challenges to the dollar, but it won't be another paper currency. It'll be a unit like Bitcoin, or it'll be a unit like gold.
Mm. That's what I was going to say. I was going to say, like, Michael, gold bugs want you to tell them that the dollar is going to zero over the next 2 years, and gold is going to be the next currency. 2 years might be a little optimistic here, though. But what do you make of talking about China and how they're dealing with their assets? What do you make of their involvement in the African natural resource market? I mean, that seems to be a big money flow too.
Well, I think it's the obvious thing for them to do. In many, China's sitting on this. I mean, China, as we know, or probably most people will understand, is an economy that is structurally imbalanced. Okay, and whereas in most Western economies, the household sector enjoys a large share of national income, in China it doesn't. So, if you like, the party machine or the state-owned enterprises of the state gets an unusually large slug of national income which they control. Now, Chinese consumer spending as a percentage of income is not a million miles away from what you see in the West. It just so happens that the household income levels are significantly less as a share of GDP, which means that consumer spending is a much lower percentage, like nearer 50% than the 70% we see in the West. Now, what that really means is that there's great potential for Chinese consumer spending to increase. But let's be realistic here. That's always been the case for the last 30 years. People have always promised it. It's never really happened in the same way, or it's never really accelerated in the way that they projected. Because it's not in the interest of the party, the Chinese Communist Party, to do that. They basically can't enfranchise the consumer because I think there's a risk of the consumer basically becoming too powerful and maybe kicking the Communist Party out. So they want control over the system, which basically means them having a large control of resources in the economy. Now, if you start to look at the economic implications of that, what that really means is that growth doesn't really come through consumer spending. It's going to come much more through government spending or export growth. Now, we've had the situation of China building the equivalent of sort of bridges to nowhere and wasting money on Belt and Road initiatives and whatever else. But in reality, where else have they got? What is the vent for their surplus? If they've got this huge trade surplus and a lack of domestic investment opportunities, they've got to go elsewhere. They've got to go outside of the domestic economy. And what better to control resources in a cheap resource continent like Africa? And that's exactly what they're doing. It's absolute common sense. It won't stop at Africa. It will go elsewhere. China will be moving that Belt and Road initiative. It will be upping the ante on that and extending it as far as they can. They'll try and put it into Latin America. They'll try and move it into Central Asia. They're already doing these things. So this is inevitable.
Correct, they are already doing these things. It seems like the Canadian government likes to try and work against that in certain occasions where the Chinese try and buy assets from Canadian companies and then the Canadian government blocks it, even though it might be in South America. So that is an interesting development. And I appreciate the answer from China's perspective, which is what you've been giving me here. Uh, but when I talk to a lot of different people, and there seems to be like a split between two groups of people. One of them believes that uh, Africa is a huge place. So I understand I'm generalizing here, but Africa is kind of done with the Chinese. Like they want to have them out. They don't want Chinese money anymore, and they want to have them out. But then I also wonder, what's the alternative? Like what from Africa's perspective, what is the alternative to take what is essentially dirt and turn it into wealth, turn it into infrastructure and more energy and better healthcare and so on and so forth. So from Africa's perspective, how do you see the Chinese involvement in the continent?
Well, I think I mean the question is what's the alternative? And the alternative is it's either China or it's the West. And the West, one would have to say, hasn't got a particularly good legacy when it comes to how Africa has been
Right.
treated. So I think that they're starting on the back foot. But I think there's nothing like sort of trying to start afresh. And one would imagine that there's still a lot of opportunity for Western companies to move into Africa and actually jointly develop resources. I mean, this feature hasn't stopped. There's still a lot of Western companies who are in Africa and doing a fantastic job helping local communities as well. I mean, I probably like you invest in many of them or a lot of them, but it doesn't have to be a Chinese company.
No, it doesn't. But again, yeah, I mean, that it really just has to be money. And then the question is, where does that money come from? Like, does it flow from the west toward Africa, or does it flow from the east toward Africa? You made a note of what you invest in, and I've been meaning to ask you this. When we talk about gold, and we started this conversation from the point of view of how would you diversify a portfolio today. When we're talking about gold, are you talking about owning physical gold or what people call paper gold, like the ETFs or something like that?
Well, I mean, speaking personally, I mean, I invest in ETFs, gold ETFs, and also gold miners. But I've just got a mix of these things because I don't know the future. And it was always best to diversify. I mean, obviously have some themes you're investing around, but you don't want to put all your eggs in one basket in case that's wrong. One could have been incredibly bullish about Russia, 5 years ago, and then had all your assets sequestrated. So that's not a particularly that's not a particularly good investment strategy. So you've got to diversify and sort of we're investing after all in high risk areas or higher risk areas where there is geopolitical risk associated with it. So one's got to be cognizant of those risks. But I still believe that if you take the broad themes that I've come back to, what's driving most investment decisions right now is this switch from the environment of what I've said is monetary dominance to fiscal dominance. And you move into a period where monetary inflation is really the key factor behind every investment decision. You want to hedge that monetary inflation.
So that's not only gold then. I mean, it brings you to other hard assets, brings you maybe even to real estate, maybe even oil. Is that how you see it as well?
Exactly. I think that you've got to start thinking more broadly. And I think the factor is that we've come back to we've talked about global liquidity being a major or key driver of many assets. That's correct. And it does affect all assets, but it affects assets in very different ways at different stages of the cycle. But I think that what I would say is that what history tells you is that what tends to drive high street inflation over the long term is the monetary element, monetary inflation. Okay. Now, the way that I tend to think of things is to say, well, look, if you think about how inflation impacts the average person, it's high street inflation that we all feel, right, as consumers. Now, high street inflation is actually a hybrid of two different concepts. It's monetary inflation, a devaluation of the paper unit, in other words, devaluation of the dollar or the pound sterling or the euro, whatever it may be, as well as a cost factor. So outside of where the governments are devaluing their paper money, what happens if oil prices spike or taxes go up? I suppose that's a government effect, or productivity slows, or whatever it may be. Those are factors that affect costs, and it's outside of the monetary sphere. So you've got to look at those two things. Now, history shows that basically what you've seen over the very long term is cost deflation because costs come down through technology, rising productivity, new resource finds, or whatever it may be. So costs tend to come down secularly. Look, for example, at the cost of a PC, how much that has radically fallen, or a mobile telephone handset, how much that's fallen, in the last 20 or 30 years. I mean, astronomically. And this is cost deflation. That's the long-term picture. On top of that, you've got monetary inflation. Now, the question to ask is, if you've got a situation where we've seen massive cost deflation over the last 30 years, why haven't we seen high street inflation? Because we've also seen a lot of monetary accommodation, a lot of monetary inflation. Now, what I'm saying is, parche the cost element in the medium term. I don't know what costs are going to do, but I assume, they're going to, let's say at best, stay flat. Then all the driver of high street inflation is going to be the monetary element. And gold is a monetary inflation hedge. It is not a high street inflation hedge. And that's an important thing to think about. Okay, so in other words, at different times, inflation in the high street will pick up or fall, but the gold price will still move independently of that. But over the long term, gold tends to move with high street prices because it's the monetary dimension which is really dominating movements in high street prices. So looking forward, what we want is hedges against monetary inflation. What are those? Gold, recently Bitcoin, prime residential real estate, good quality equities, okay, because those companies, big companies, can pass on the inflation in costs through keeping their margins robust and passing on price increases. And you probably also want commodities because they will be moving with the gold price. Commodities have two moving parts. One is the currency of denomination, which you can think of as an element like the gold price. And the other is, if you like, a business cycle effect, which is more a technical factor, which is thinking of, let's think of an example, the oil to gold ratio. So if you think of the oil price in dollars as being made up of two things, the gold price in dollars times the oil to gold ratio. So the oil to gold ratio will move with the business cycle, and the gold dollar price will move with monetary inflation. So you've got those two moving parts. If you think we're in a business cycle expansion, it's quite likely that oil will outperform gold. Similarly, copper will outperform gold if you think that we're in a technologically stage where copper usage is going to go through the roof, as many people say. The copper gold ratio is going to go up, and if the gold price goes up as well, copper's going to perform dramatically. So if that makes sense, that's how we think about these elements.
There is a supply side of the story too, though, where again, following global liquidity and flows of capital, what we haven't seen over the recent decades is a lot of money going into, you bring up copper development and copper exploration, and it's become more expensive for us to find copper pounds in the ground. Is that a thematic that you're following too?
Yeah, I mean, that comes into the copper gold ratio. So if you've got supply constraints in the copper market, the copper gold ratio is going to go up faster than another commodity, maybe tin or lead, where it's easier to find. So that will clearly factor in.
Yeah. The thing that I particularly like listening to you, Michael, because you have a very holistic view of things that kind of incorporates everything, and everything flows very logically. And I think that understanding global liquidity is probably giving you insights into geopolitics that normal plebs like myself may get from mainstream media, but still not fully understand. And uh, is global liquidity helping you, given that it's helping you understand geopolitics, is it also helping you understand the risks involved with investing in some of these challenging jurisdictions? Like when you look at, there's a lot of natural resources in South America. Like you have Bolivia, which is very challenged, for example, and all other jurisdictions are. Is your analysis giving you any special insight into jurisdictional risks?
Well, I think if you come back to, I think it does, in the sense that what you've got to do is you've got to invest in jurisdictions that have got monetary stability. I mean, that's for sure. I mean, maybe to choose a sort of crazy example. I mean, Zimbabwe is a country with a lot of natural resources, but it may not have been a wonderful place to invest because actually it was politically unstable and monetarily unstable. And so, you wouldn't have got very much, even if you got the right resources, you wouldn't have made a lot of money at that, as far as I would see. I mean, Argentina in the high inflation days was another example. So you've got to be very careful about what you choose. So I think if you're investing in commodity-based countries where you've got monetary stability, that's the best of all worlds, for sure.
Hmm. Any specifics. I mean, I just brought Bolivia up as an example because that's typically what people are afraid of. Any specific jurisdictions where you say this is a jurisdiction that most people are afraid of, but they shouldn't be afraid of?
I think that's a hard one to say. I mean, to go back to your Africa example, I think that you can. I think that my view would be a lot of African countries now, because of the competition with China, are probably in a more stable environment because they have to be. So, in other words, the West is overseeing them and trying to make sure that they don't derail too easily, because that would throw them the arms of China, to mix my analogies, but that is what I'd say. I mean, I think the other case in point is to say, well, okay, what's wrong with investing in Canada or the US? They're big resource economies, or Australia. I mean, they're pretty decent places to invest in. They're politically stable, they're monetarily stable, and they've got, cheap and pretty good resource companies. So why not go there? Why do you need to take all these big risks?
I suppose for the potential of reward. I mean, I was just wondering myself, like, why do I take these risks? And it goes back to the potential for the reward, of course. But you have to be aware that you are taking those risks, I suppose.
Yeah, but I mean, investing in commodities is a risky venture anyway. So why not do it in the comfort of your own economy?
Sure, sure. So what? I mean, yeah, you've kind of this whole conversation has really been an answer to the first question, which was how do you diversify that portfolio? What would the exposure, like, what would the weighting be, though? You mentioned prime real estate is what I wrote down. Gold, other commodities is what you mentioned in there. And then potentially Bitcoin. What would the weighting be of all these different asset classes?
Well, I think that depends very much on the individual. I mean, that you'd really require a sort of bespoke portfolio, I think, by person. And as I said right at the beginning, I mean, you've got to ask, number one question is what is your investment time horizon? If someone says, okay, we've got an investment time horizon of a year, my investment advice is going to be radically different than if they say it's 10 years. So I think that will affect the mix. But if we try and look through that, and let me say, let me try and put my head on the block and say, well, okay, if we're comparing a 60-40 mix as a standard asset allocation, how would I alter that now? And I'm not going to address the residential real estate question, because I think most people have their home as their, let's say their residential, their prime real estate asset. So let's just look at the financial part. I would basically start to think about still keeping 60% in equity, as a structural, weighting. That will obviously alter through the cycle, but let's say the core is benchmark is 60. I would tend to think about having somewhere between 15 and 20% in Bitcoin and gold. And I think that where you draw that line is probably an age factor. So if you're very young, you probably want to have more in Bitcoin. And if you're older, you might want to have more, you have more comfort in the gold bit, perhaps. I think that on top of that, you want to think about index-linked treasury bonds, so TIPS. I think treasury TIPS at over 2% are a fantastic opportunity, because it's really difficult in investment markets to earn a real return of more than 2%. So if the government is giving you 2.2%, which they are currently, in the TIPS market for 10 years, that's actually worth having. So I'd certainly have a decent chunk in that. Maybe perhaps another 15%, let's say, in tips. And then in terms of what other assets, I'd have cash, because cash is currently giving me 5% real, sorry, 5% nominal, which in real is pretty good. So again, I'd have money in cash, maybe the other 10-15%.
Hmm. This is awesome. Thank you. I thought we were gonna have to dance around this, but you've been very straightforward, and I really appreciate it, Michael. Let's cut it here. What else am I forgetting to ask you, though? What did you come here hoping to talk about that I'm failing to bring up?
I don't think anything really. I think what are the big challenges? I mean, the big challenges in global markets really come back to, um, I would say, ultimately currency questions. Those are the big questions, and what the axis of that is really two things. I mean, one is the dollar and one is the Chinese yuan, and that then spills out into what happens to gold, etc., which we covered. But I think the reality, as far as we can see, is, and where the big mispricing is in the world right now is the Chinese yuan, the Chinese currency, is structurally overvalued. Now, that's not how most people see it, because most economists, throw their arms up and say, well, look at this big trade surplus. All the textbooks tell us is the Chinese yuan should be going up, not down. But that's a complete misreading of what's going on, because China is effectively a dollarized economy. So it's like thinking, what you ought to be thinking of is China like California, if that's the right way of thinking about it. But basically, it's a dollar earner. So the more that China accumulates in terms of a dollar surplus, that's actually driving the dollar higher, not lower, and it's driving the yuan down. And what China desperately needs to do is to get off the dollar hook, but that's a lot easier said than done. And that's what they're trying to do, but that's going to take decades and decades to do.
That's a good note to end it on. That would kind of be like a mic drop moment to end it on, Michael. But I appreciate you stopping by. It is crossbordercapital.com for people listening. Michael is also on Twitter, where you can find his Substack and whatnot at crossbordercap. And again, he's on Substack, really, where it's capitalwar.substack.com, excuse me, where you can go and read his Substack. So thank you, Michael, so much for investing your time. I mean, I really do appreciate it. I'll let you drop off now so I can jump into the CEO barbecue portion of today. Not before I've gone through my favorite part of the CEO barbecue here, though, which is, of course, the disclaimer. Some people think I spend too much time on it. I think I spend too little time on it. I should make a 20-minute long video each week only talking about why this disclaimer matters. But it does. There's a warning on your screen right now. You're obligated to read it. I am making you obligated. I'm making you obligated. Is that a thing that people say? You should read this thing, because it's not just some disclaimer. Well, I suppose it is a legal disclaimer, of course, but it's also an actual warning that will help you not lose money, or maybe just not lose as much money. And yes, just give it a pause and read it. I want you to be aware of the fact that the two companies that you're going to hear from today, they have not paid me anything to be on here. I have not I've not shared the questions up front, as I never do. Those are the Resource Talks interview rules, as you might be aware of. No questions up front, no questions off the table, no editing rights for the companies. Easy, sweet, and simple. Unfortunately for me, not all most companies don't really want to pay for that. I'll figure it out eventually. But even the companies that are not paying, you should still understand that they're likely seeing their participation in this program as a chance to do some marketing. So start by understanding that most company communications online, whatever it might be, this interview, other people talking about these stocks, people being on whatever anonymous, whatever it might be, the company's presentations, the company's websites, all of that is marketing tools. You should know that those are not research tools. For research tools, you go to setterplus.ca, which is a government official website where you're going to find the company's official government filings, like the top three that you have to read: management discussion and analysis, that's the MD&A. You want to read the financial statement, and you want to read the management information circular, which is the document telling you how much money the company is getting paid. And then if you feel like going crazy, you can also read the technical reports, which are going to tell you everything about the rocks. If you don't understand them, ask someone to read them with you. I try to read as much of them as possible before doing these interviews and ask some of these questions. And although I don't make buy or sell recommendations, because there's a clear conflict of interest, many out there will do. And so you should be aware of that inherent bias. You should be aware of the fact that whenever someone's talking about a specific company name out there publicly, there's some agenda, okay? And just assume everyone's biased out there. Assume everything is marketing out there. And anytime you're watching any type of specific content, a company-specific content, approach it with a dose of healthy skepticism and treat it as marketing. That's pretty much it. Well, I said everything, I suppose. Oh yeah, as always, very unfortunate for me, but I'm not a magician. My crystal ball doesn't always work too well. So I don't possess any superior knowledge about what is going to go up, what's going to go down, and what's going to go in circles. I don't know. So no guarantees here, besides that there will be forward-looking statements in these conversations. And also another guarantee, those are conversations that are general. They're impersonal in nature. They're not talking to you. Okay, they're talking to me. And luckily for you, you're not me. And those conversations are going to contain hopes for the future events that may or may not take place, depending on many different factors, both within and outside the company's control. Be aware of these things. Be aware of the inherent risk to investing as well. Investing is risky. and investing in the mining industry even more so, especially when we're talking about illiquid investment products, which most of these juniors are. If you don't know what that means, even if you do know what that means, you should still talk to a professional investment advisor and see what they tell you. Make sure they're licensed, as well as do more research, as I said, before taking any decisions, any of your own decisions in the end. The disclaimers on your screen right now, there's 2 in total. If you don't enjoy losing money, rate them and be careful out there. That's pretty much all I have to say here, because I'm running out of breath, and I am also going to have to be going back to Canada, Quebec in particular, where I've been spending a lot of time lately, and for a good reason too. And this time I am looking at one of Canada's largest proposed, so it's not yet a mine, but it's a proposed gold copper mines, and hearing about it from Justin Reed, the president and CEO of Troilus Gold Corp. Troilus is listed as TLG on the TSX main board in Canada, where an average of about 300,000 shares trade each day, with a 52-week high of 85 cents and a 52-week low of 31 cents. With a market cap of, call it $100 million and about 285 million shares outstanding, today this is a 35-cent stock. There are 8.7 million warrants, and there are about 14 million RSUs. There are no regular options outstanding. So that leaves the number of fully diluted shares at about 308 million, with insiders holding about 8% of the company and 50 institutional funds holding roughly 65% of the company as well, leaving only really about a third of the company in the hands of retail investors. The last financial statement, which is dated April 30, shows me about $26 million in current assets, most of which at the time, so $15 million to be specific, was in actual cash. And there is almost $8 million in tax receivables, and there is a little over $2 million in investments. I see a small long-term portion of a lease liability equal to about $250,000 on the long-term liability side of the balance sheet. And then on the short-term or current liabilities, I see about $7 million, mostly in the form of account payables. That same financial statement from April also tells me that on average, over the last reported 3 months, Troilus recorded about $400,000 a month in administrative expenses. That's excluding share-based compensation, with the majority of that money going to salaries, payroll, consultants, marketing, and stuff like that. As to the exploration expenditure for that same period, the number they published was at around $5.1 million for the entire period, which equals about $1.7 million per month on average over the last reported 3 months, with drilling itself making up a little less than half of that spent. So from a ratio perspective, this means that Troilus' total cost over that period was split roughly in an 80-20 fashion, with exploration being the 80% and administration being the other. No, what did I say? Exploration being the 80% and administration being the 20%. So as always, though, this is nothing more but a snapshot in time. So it is not necessarily fully representative of how this company runs or is going to run in the future. So please head over to the company's website as well as setterplus.ca to look at all the numbers yourself to make sure you're getting the full picture there. For Troilus, that full picture will be, as I mentioned, rather large because they own one of the largest undeveloped gold equivalent deposits in North America. And I'm saying gold equivalent because, as I mentioned, it's copper gold. And when looked at through the copper lens, it is the largest permitting stage copper project in the province of Quebec. This is also there is a past producing mine on the project, so it is technically a brownfields project where copper and gold came out of the ground for almost 15 years, and that was between 1996 and 2010. Since then, multiple things have happened on the property, as you can imagine, all of which has culminated into a final feasibility study, so an FS, showcasing a rather large open pit 22-year mine life asset with a base case NPV 5 of a little over $1 billion. This is Canada, though, and again, it is a rather large undertaking, so it won't be cheap to build, with the initial capex estimated at over $1 billion, and so resulting in an almost 5-year payback and an after-tax IRR of 14%. Once in production, the asset is expected to generate roughly $150 million in annual free cash flow, though. But again, the stock is trading, as I mentioned at the beginning, at under $100 million in market cap. So this may be a good point, actually, to open the conversation, Justin, because I'm just thinking, how come? What do you think the market is not liking here?
Good day. First of all, thanks for having us on, and thanks for that intro. Yeah. So what's the market not liking? I think first of all, we're coming in the wake of significant inflation being seen in the broader mining market. We are looking at a number of similar size and some slightly smaller operations getting built and significantly showing cost overruns. As well, we're the first feasibility study really in the last few years that takes into account the true picture of the current inflationary window, especially within North America. And then I think the broader market, where it's a risk-off trade, and you're not seeing a lot of new capital come into the broader exploration / development markets as a whole. I think if you go across the board as a whole, all of our peers, including and Troilus, are trading at, certainly well below anything that could be considered a peak multiple. With to your question, and very Troilus specific, I think that probably the capital caught people off guard a little bit. We put out a PA that was 4 years ago that had a much shorter open mine life at 35,000 tons a day that then transitioned into an underground operation. And the capital for that was about $350 million. Of course, we're 4 years later, inflation has hit. We are approaching this mine at a much larger scale, 50,000 tons a day, one of the largest mines in Canada. And I think the US $1 billion capital number, especially for our retail shareholders, I think scared them a little bit. What I would say is that the institutions, our large institutional investors, financiers, and then strategics involved in our company, we're not surprised by that number at all. In fact, I think we had to spend a lot of time explaining why that might be too low. Because as we've presented to our shareholders and on various presentations before, we've inherited a significant amount of existing infrastructure through the past operation that you described. And we've upgraded it. So the roads are in. The power lines are in, the substations are in. A lot of the preliminary civil works are completed. Water, septic, sewer for up to our 1,800-man campus, and probably most importantly, our tailings facility is not only in, but permitted and ready to go. And so that brings about a US $500 million in capital savings to our project. As well, the cash flow profile for this operation at long-term prices, not even looking at current prices or any upside scenario, we're easily able to finance a $200 million fleet within that. So if you were to build this from scratch in a greenfield site and fully purchase your fleet, it would be almost a 1.7 billion US build, which is very analogous to Greenstone, Côté, Detour, and other very similar deposits. So I think that there was maybe a little bit of sticker shock for a company of our size, which is acceptable. And I also think that we had a lot of faster money enter our name during the run in gold up to $2,400 plus, $100 gold plus. And as such, at long-term prices of 14% after-tax IRR, I think maybe they thought it was a little bit low. And what I would say is that when we look at similar type of deposits, Côté, Greenstone, Detour, Malartic, the largest producing and soon to be producing gold mines in Canada, those are the type, when you have significant capital intensity, $1 billion plus upfront, it is incredibly difficult to drive a plus 25% after-tax IRR. It just doesn't happen, simply because of the capital intensity upfront and the payback period associated with it. However, these are the mines that are actually getting built. And we've seen it. We see the two most profitable gold mines in Canada right now are Detour and Malartic, and are very representative of what Troilus is going to be. So I think there was a little bit more education that maybe we had to do to spend time with our retail shareholders, but certainly from a retail or from an institutional standpoint, I think it was right in line with the expectations. If we look at the long-term pricing, or sorry, not long-term, spot pricing today, you know, it becomes a $1.6 billion after-tax IRR as of today, and about NPV, and about a 20% after-tax IRR. So it's all like you said, it's a snapshot in time, and our whole focus for the feasibility was not to inflate the numbers for a small portion of the market for perception. Our focus on the feasibility was, in light of the disappointments that have occurred, to be the single most representative and reflective financial analysis of this deposit at the current time. And I think we were able to accomplish that, because the majority of my time going forward is going to be focused on financing, partnership, and moving this project forward. So very long-winded answer to your question.
But so you understand that, and you're helping me understand that. There's definitely others out there, as you said, your institutional shareholders, who also understand that. But for all of us to make money on this thing, we have to see the market understand that as well, or see the value in that $150 million annual free cash flow that you're expecting here. What can you do to push the price of the company closer to what you believe its real life value to be?
That's a great question. You know, we're certainly fighting the wind as far as evaluations of juniors, and we need to break out of that. Right? There comes a point of differentiation across all of the companies who are saying they're going to do it and those who are going to do it. And so for us, it is there is a very well-established path forward for us. And these are not sexy deposits. You do not get a lot of market attention on 100 meters of a gram or 100 meters of 0.8 grams. So for us, it's about head down and moving the project forward in a very systematic, methodical way. The feasibility was a culmination of 4.5 years of work, 350,000 meters of drilling, and you know, identification of a 13 million ounce equivalent resource, of which 11.2 is indicated, almost a 7 million ounce reserve. And for us now, that's great. There's lots of those out there. The next step is, how do we take advantage of the feasibility, the economic framework, the brownfields infrastructure that we have, and that's about turning it into cash flow, as you said. So for us, it's permitting. I think that in Canada, it's a long permitting window. There's a lot of bureaucracy, and at times it can take upwards of 4.5 years. I think what the broader market doesn't understand about Troilus is that we've been permitting for well over 2.5 years. Our detailed project descriptions are in federally and provincially. Terms of reference are done, consultations are complete, all the data is compiled, and towards the end of the year, we will be submitting our EIA for a brownfields project. There is a very high likelihood, and there's a lot of variables to this, but towards the end of next year, Troilus could be completely permitted. And so we are not talking about a cash flow window that's 4 years away. We're talking about a mine that's going to be permitted. We will have financing in place. We will have an operational team in and/or a partner in, and we will be moving towards construction in a matter of, 18 months or less. And that is about de-risking, technical de-risking of this asset. Feasibility is done, permitting's in place, financing's in place. The team has been enlarged to bring in a great operational team, and we'll be moving forward. And when you look at the history of very similar companies like Detour, at the Detour mine, the original Cisco at Malartic. That's what you saw. You saw the exact same thing about de-risking this asset towards production. And so that's everything that we're doing. We need a market behind us. We know that. But we can control what we can control. And right now we can control delivering a technically bulletproof asset, both financially and on the regulatory side, which is not typically valued right away, but as important as your asset in many cases.
Is that what it's going to take for you to get a potential major interested? Or like how far up the Lassonde curve do you think you have to take this for a major to get interested in placing a bid for the asset?
I think we're there, to tell you the truth. The feasibility was the single biggest thing for sure. Previous to our feasibility, we had been talking about 35,000 tons a day, which was not the correct scale to probably bring in a potential partner. At 50,000 tons a day, you know, we're talking 22-year mine life minimum. That's off half of our resource. So, you know, there's still another, call it 6 million ounces equivalent sitting out there in the indicated that could come into the reserve. And it does not include any of the exploration that we're showing at the West Rim and everything else we're doing. So Troilus, I'm speculating. I believe Troilus is going to be over a 30 to 35-year mine life easy. Second of all, at 50,000 tons a day, we have average life of mine production of 300,000 ounces plus a year. That's, you know, 80% gold, 20% copper, and a little bit of silver. That peaks kind of in year 4, 5, and 6 at almost 540,000 ounces equivalent a year. This is absolutely huge. So again, majors are in no rush. They've been very busy merging with each other, cleaning up their balance sheets, turning into real businesses, paying off debt, buying back shares. And I think we're just now beginning to see the asset purchase stage, the growth stage of majors and mid-tier companies coming into fruition. Because I'll sound like a broken record, not from me, but from everybody else. We do not see majors organically replacing exploited reserves. And there are very few assets in the world that will give the scale and scope of Troilus. Plus the leverage to multi-commodities. We are not just a gold producer, we're a copper producer as well. And I think in the world of electrification, we see all the major companies now not talking about gold, talking about gold and copper as their growth. And so in Canada, you don't have a lot of options. So
having that significant deposit, as I mentioned, also means high capex, really. I mean, it's over $1 billion. Is there something you can do in that process from, say, a starter pit perspective, maybe, or build a smaller mill first? Instead of 50,000 tons per day, do a 10,000 tons per day process, the high grade stuff first, let the bulk pay for the bigger mill or whatever it might be. I don't know, something to improve those off the bat economics that you're talking about.
We've looked at that, and there is some optionality that we're looking at now that I don't have finite numbers on, so I won't discuss. However, Troilus has a lot of pre-strip with it. There was very little condemnation drilling done historically by the previous operator. And so our pits are essentially tripling in size, massive pushbacks, massive strike extensions. And as such, we have to move a lot of waste piles to get down to the new ore. And as such, that's going to take a lot of upfront capital to get at. And so, and also at the grade, the best grade that we see is actually at the bottom of the old 87 pit and at depth. So the West Rim, which we're drilling right now, is showing some very interesting opportunities to us, and there is. But realistically, when you looked at Detour, when you looked at Cote, all the ones that I've described earlier in this interview, when you're kind of talking 1 gram or less, unless you have a 1.5 gram pit, which we don't, it's going to be very, very hard to do. So the opportunity is there. We have to do it with the drill bit. But certainly with the mine plan as it's laid out now, we don't have the ability to. However, there is significantly higher grade in the belt, call it within trucking distance of our mine. There are other potential operations in the district that could provide potential higher grade feed. So it's something that we're definitely looking at. But right now, with the focus on permitting, the one thing we don't want to do is change the scope. The moment you change your scope, you're in many cases, you're resetting your permit clock. So this is something that could be amended after the fact, but we also don't want to mess with our timeline, which has a huge value to it as well.
There are thresholds when you talk to major investors or mining companies, or are they telling you something along the lines of, I need a 3-year payback and a 25% IRR to even take your call or anything like that? Like, what kind of guidelines are they telling you that's guiding your decision-making process?
Not so much that, because I mean, you look at a lot of the expansions that are being done now by majors, the IRR is in single digits. So you know, when you're looking at a major, their cost of capital is going to be significantly lower than ours, first of all. Their access to technical expertise and probably overall operating costs are probably going to be significantly lower than ours in many cases as well. No, it's not so much about payback and IRR. It is more about scale and life, right? And so for us, you know, majors aren't interested in 100,000 ounces a year for 7 years. They're not. I would say that 200,000 ounces a year or equivalent over a 5 to 10 year period, probably not that interested. You know, but when you are a 1 million ounce plus producer, or significantly more, 20-year plus, 200,000 ounces plus during that period, that provides you a cash flow stream from which you can make major capital decisions over a 5, 10, 15-year period. And that's what they're doing.
I'm also wondering about the corporate strategy behind. So I was going to ask you, like, okay, what do you do in the meantime as you wait for maybe better days? I mean, how do you communicate to the market that, hey, there's more upside? Like, we get this permit, the stock is going to go up, because that's what retail wants to hear, right? They want to hear that last part. The stock is going to go up. What are you going to do to make the stock go up? But how does it, from a corporate strategy perspective, how does it make sense to keep pouring money into the asset if the market is not giving you value for it right now? Maybe it does later down the road in better metals prices and whatnot, but how does it make sense to keep investing in it now?
100%. That's the right question. You know, at one time we had 7 drills plus turning, right? And we were adding that resource. Troilus doesn't need more ounces. We're not getting the value for the ounces we have. We don't need more ounces right now. We have 1 drill turning through July, and then that's going to shut down. And that's really defining what the West Rim could look like. And we're excited to get that to the market. We have regional exploration going on some of the higher grade opportunities that we have, but that's really boots and hammers and trenching, very low cost dollars, which is going to open up other targets from a belt perspective. And that is low cost technical advancement that could repay significant value in the future. Because again, potential partners or purchasers are looking for belt scale. They don't just want an asset, they want a belt. And so I think we're able to do that. You'll see that going through this year, our technical spend on exploration will certainly be reduced materially. Our focus will be on about moving the asset forward. We also, in your financial summary you gave, like I said, we have this significant infrastructure at site. It's a huge cost center, but provides an unbelievable amount of ultimate value to us. And so that's one thing that Troilus has, I think maybe that a lot of other juniors don't, is, you know, our cost of operations is always large because we have to keep the pumps running on the tailings. We're actively dewatering the pits right now. So there's a lot we have to do for maintenance of the existing infrastructure to make sure that it doesn't degrade. And that's going to add value as well. But certainly you're going to see our exploration spend come down. You're going to see, I think, our total SG&A retract. And a lot of our focus is going to be on the next steps of advancement technically.
How much money are you budgeting for this year then for all that work?
You know, this year for the remainder of the year, we're probably at about $8.5 million.
Does that include G&A?
Yep.
For the remainder of the year, that's a half. Well, that's 2 quarters. Okay, so significantly less because the numbers I went through was
you're going to see a material reduction in our numbers,
right.
And in fact that'll start flowing out shortly, is happening now. But we always have to maintain a certain level of liquidity for the assets, right? We're not an exploration company that puts up tents and has a resource that we go see once a year, right? We have a 100-man plus camp that requires maintenance. It's always staffed, not with 100 people. I think we have 60 there now, maybe a little bit less with the summer program. But yeah, we have to maintain that. So this is where our great institutional shareholders have really been so powerful for us, is that, you know, this company can't be run on with $2 million in the bank. So, you know, towards the end of the year, obviously we'll have to come for a small top up, but we're looking at alternative methods to do that right now. Now that the feasibility is out, we have a lot of options available to us. And certainly the feasibility has provided a framework and a roadmap for us, where we are moving, you know, potential partnerships forward and strategic investments. So we're well advanced there.
Well, because I was going to ask you exactly that, because you mentioned previously non-dilutive ways of financing going forward. I was thinking, what would that look like more specifically? But now that you told me that you want to spend $8 million for the rest of this year, I'm thinking, is that a necessity? I mean, do you really have to make any moves? Like, you have enough cash in the balance sheet to just sit this one out?
You never have enough cash on the balance sheet, but you're right. We're in good shape. And so we can't slow down the permitting side and the engineering side. Those are critical path for us, for sure. Whether the market wants to give you value today or tomorrow, you do not slow down the permitting process, because that's not adding months, that's adding years if you slow that down. So for us, that doesn't slow down. The exploration is discretional, for sure. So we are kind of wrapping up the work that we're doing, and then we'll see where we are. So yeah, we're in really good shape. I'm very pleased structurally with where we are now.
But so you don't, I mean, just to clarify, you don't need to raise capital this year.
We don't need to this year.
Okay, with emphasis being on you don't need to, but if money's there, you'd take it.
It has to be the right circumstances, right people, and the right price.
Okay.
Right. And there are times when a capital infusion can be very important to the company if it's with the right groups.
What about royalties and streams? Would they classify as the right groups?
Yeah, you don't want to encumber the asset, to tell you the truth, going forward. We purchased our 2.5% royalty back from First Quantum in September of 2020 for $20 million. And at that time, I don't think our shareholders were very happy that we did it. However, in hindsight, it was probably the best move we've ever done, to tell you the truth. Because that leaves us a huge amount of ultimate flexibility down the road when we permit the mine, or sorry, when we fund the mine. But, you know, I'll put it into perspective for you. About around 1% of our total revenue will come from silver. And so materially, it doesn't have a huge impact on the value of Troilus going forward. However, We have had a number of analysis completed for us by our various bankers and financial advisors. And, you know, if you take kind of the last 5 or 6 precedent transactions in the market, that silver stream could be worth anywhere between 50 and $100 million US, depending how close you are to production on a 100% basis. So, you know, those type of things I think we could look at and consider, as it really doesn't have a long-term impact on the total value of the Troilus asset, but could provide alternative sources of financing for us. So I'm not saying we're doing that, but I'm just saying it's one of the things we're looking at. We have, you know, we have over $2 million of equity in various other exploration and early development companies. You know, we own about 20% of Prospector, which has this great project called Mike Lake up in the Yukon. It was non-core to us. We inherited it. We sold it to them for 20% of their company. Yesterday, B2 Gold came in and bought 10% of the company for this asset. We've seen massive appreciation there. We own a lot of that company. We own a lot of Delta Resources in Ontario, which is, again, a brand new discovery, which we think has a huge amount of legs. And there's a couple other things we're working on, again, non-core assets to our company. We sold a lot of our non-core ground after significant technical examination to Sayona Mining in Australia for cash and stock about 2.5 years ago. That brought in the highlighted number was kind of $50 million. Their stock went down a little bit, but we brought in over $40 million on that, and we were able to fund the company for a significant amount of time on a non-dilutive basis. So we're always looking for opportunities, and we have them.
I'm thinking how you deal with that, because so the equities that you mentioned there, it's 2 million, so it's not necessarily too important of a point of discussion here specifically. I don't think.
No.
They're oftentimes illiquid. Like, how do you sell Delta's down a lot? How do you get out of that without hurting them further? So those are points of consideration, but maybe not too important to discuss. There's one other option for financing, I suppose, that you could go for, that I've heard you mention before, and that's negotiations with potential off-takers. How do they work, those negotiations? Like, what do you tell them? What's their pushback, and what do you answer to that?
Yeah, so, you know, Troilus is in a unique position. We're going to produce, depending on the year and the stage of development, between 75 and 78,000 tons of concentrate a year, which is, from a Canadian perspective, is pretty significant. That concentrate is incredibly clean, so there's not a lot of nasty elements in it. It's very precious metal rich, of almost 100-gram gold and almost 200-gram silver. So it's an incredibly high demand. And when you're looking at that volume of concentrate for the period of time we're looking at, to be able to secure that is incredibly important for the life of a smelter that has capital planning periods like our 10 years and beyond. And so, you know, I'll give you one example. The Horn smelter is, I think, is about 600 kilometers from Troilus. I don't know the exact number. Glencore operates it. They're investing almost $1 billion upgrading it and cleaning it up right now. They need 700,000 tons equivalent of concentrate a year. And, you know, Troilus would be 10 to 12%, if not more, of that. You make that kind of capital investment in the province, Troilus could be the largest single source of concentrate to that smelter. That's important. And if you could lock that up, whether Troilus builds it or somebody else builds it, you know, you could sell that right for it, right? Glencore has a number of competitors, Trafigura, Ocean Partners, Erebus, Boliden, and others, a lot where the Troilus concentrate went in the past, who are all looking for clean sources of concentrate. So this is something we're working very, very hard on. and provides a huge opportunity to us, not only for, call it, short to midterm financing needs, but also from a long-term perspective, building this forward. We have a number of paths we're moving forward on, and certainly that's one of them.
You also mentioned permitting there for a second, and I'm kind of jumping topics here because I know that we really only have about 15 minutes here. It's interesting within that context too, because this is a proposed open pit project, typically more challenging to permit, at least in my mind. What does the permitting process look like for you from here on out, specifically sort of on a step-by-step basis, and more importantly, maybe how long is it going to take you to permit this thing?
I guess the first thing as a disclaimer is any time I give you is probably going to be incorrect, right? Because it's always a moving target. What I would say about Troilus is we have a bunch of things going for us. First of all, we're on an active mining lease. We had a mine that operated for 14 years, that was fully permitted. We have a fully permitted tailings facility, and we're inspected quarterly. So this isn't a greenfield site where we are projecting or inferring what the disturbances are. The government knows, and our stakeholders know and understand what the disturbances of Troilus are going to be. We're not reinventing the wheel. Everything we're doing was done before. So there's a deep knowledge of what Troilus is and what it's going to be. So the education, which is a lot of it, especially with your stakeholders being the First Nations, is incredibly well understood. Second of all, the great thing about Quebec is there is a very defined process. And we are, like I said, we're well through halfway through that now. So after our EIA is submitted, consultations are complete. It'll then go to, I think there's a total of 105 different permits we need, but obviously the big one is to get in construction. It'll go to the COMEX, and the COMEX is a James Bay specific regulatory environment board, which is made up of the Quebec government, the Cree stakeholders, and the local stakeholders. And again, they're very, very well versed, and we'll work through COMEX approval, and then it goes to the province for ultimate approval. And again, we have all of these committees and agencies are working with us now. It's not like, here's our report, we'll wait for you to review it. They're reviewing all the data as we go through. The guidelines and the way that we're submitting it have been essentially pre-reviewed. And so I would say if I had to permit anywhere in Canada right now, I'd want to be permitting in Quebec, and a brownfield site is going to make it significantly easier.
With what's just happened in the Yukon, which is granted very, very, very far away from where you're at, but with the heap leach pad failure there, isn't communities relation, or is that going to become tougher? And are they maybe going to start paying more closer attention to how and why certain infrastructure on mine sites is built the way that it is? And so for you specifically, your technical report, by the way, mentions potential issues with the long-term quality of the water, as well as the geochemical stability of the waste rock and so the tailings and so on and so forth, which is not necessarily out of the ordinary for these types of operations, but they are risks that you will have to think about and potentially present to the community. So how are you going to be dealing with those?
Yeah, no, a spectacular question. What happened at Eagle and for Victoria Gold was terrible. I mean, it was, I know every member of that team, and I got to tell you, they're great professionals, and it was kind of a tragedy what happened there. Just to put away, first of all, we don't have a heap leach. That's one. We're not. They are vertically challenged there in the sense that everything is mountainous, valley fills. So everything is built up. And maybe the single biggest point is they use cyanide. The majority of gold operations do. Full blanket statement, Troilus, our process uses it, which is not innovative. we're producing a concentrate. We use absolutely no cyanide at site. So as far as the biggest flag or hurdle you might have in any kind of environmental permitting, it's use and destruction of cyanide. We have none. So that's first. Water is always your biggest issue, hands down, especially with our Cree partners. We, in our feasibility, we have all the disclaimers that are out there, but, the biggest, I'm going to say, alteration we're making to the water course, if you will, is we are moving a diversion channel. So there was a diversion channel built for the old mine. It's straight as an arrow. We are rerouting that diversion channel. So we're diverting a diversion channel. So it's already, again, a disturbed infrastructure item that we're actually making better. And the plan that we've put forward for our diversion channel, and we're moving it about 1 kilometer farther to the west, was put in place with our Cree partners. So this wasn't Troilus saying, here's what we're doing. We actually held a number of meetings with WSP, which is the old golder, and all of our Cree partners. And we said, here are the 3 plans that we have to divert this channel. Which one do you like? And at the end of the day, we kind of took a hybrid of all 3, and we're basically building a new creek with migrations in it, spawning areas, and we're happy to put forward that it was actually the Cree plan that we put forward. So we've mitigated that, if you will. It will still come under more scrutiny, but I think it can be easily managed because we're making an existing infrastructure item better. With regard to the waste rock, always a concern in any mine site about acid rock drainage. I think the beautiful thing again about Troilus is that it operated for 15 years. It's been sitting dormant for another 10. So we have 25 years of data that our waste rock does not generate any acid rock. As well, we've done full 100-year cell tests on it that show the same thing. This is very technical. We're actually publishing a paper with the National Research Council of Canada, which is the government who's permitting us, on the neutralizing properties of our waste rock, believe it or not. So again, these are all very fair comments from you and things that will absolutely be looked or scrutinized. I think we have done a very good job. It's cost a lot of money identifying them early, mitigating them, and actually adjusting for them. So, and when you look at Troilus compared to Eagle, I mean, it's very different. We're flat. We have all the ground in the world we need. We have no shortage of land, and our tailings is only about 12 meters high now. We'll have about another 5 or 6 years with a couple lifts. So it's never going to be a 200-foot or 100-meter plus item. It's going to be very flat and down. And the government has guided us to, and part of the reason why we're mining the Southwest deposit early is in-pit disposal is the preferred method by all regulatory bodies now. And so we'll be moving towards in-pit disposal at the end. So we've addressed these, I think. We can always make them better, and they're going to get better, but we've addressed these early on. But very good question.
Thank you. And we've kind of been talking about this whole thing as well. It's going to be one operation, but we've kind of approached your project as one thing. In reality, really, it's this FS is based on 4 deposits, as far as I understand it. They are not all exactly the same, most as far as I understand it. Correct me if I'm wrong. There are different recovery rates, for example, between some of them. Do you think that could pose a challenge during processing and maybe complicate things? And is there something you can do beforehand to optimize that process?
Great question again. No, it's not going to be a problem. So first of all, we have 14 years of historical data from 87 and J, and that makes up probably about 80% of our total ore extracted. X22 is new. X22 is new, and Southwest is new. The others have just gotten bigger. We've taken that 15 years of historical data. We've then taken over 10,000 kilos of bulk samples, and we didn't do pilot tests. We built a full, or sorry, we didn't do bench tests. We built a full pilot plant. And so we have done metallurgical test work on every deposit, every ore type, and every subzone of that. And from that, we've just put out some X22 results as well. We're incredibly happy. The results vary from kind of 86% or 85% in the Southwest up to 95 in 87. But on a blended basis, we're going to be able to get well over 90% gold and silver life of mine and copper. And so from that standpoint, we have it in very great control. We showed in the feasibility and in our press releases out the variability in production. Variability in production is a function of what zone we're in and what grade at the time. But metallurgically, I would say we have as good a handle on it right now as anybody could, and we have a huge amount of confidence.
I'm specifically going in that direction here, Justin, with the conversation, because, and I'm glad you brought up the historic operation, because if my research is again correct, the historic Troilus mine shut down in 2010, partly, not solely, but partly because of the low gold prices, of course, but also partly because of operational cost overruns that were at the time relating to lower grades and recovery rates, which they hadn't anticipated before. So I suppose twofold the question here, but let's start with the first part. Is that true? I mean, is that why it shut down?
It was two things. First of all, obviously the environment they were in. And then you have to understand a bit of the history of InMed. InMed had two other things going on at the same time, right? They were operating Troilus, but they were building La Cruces in Spain, where a huge amount of capital was going. And they had discovered and were engineering Cobre Panama, which ultimately led to the hostile takeover after a failed merger with Lundin. It was all about Cobre Panama. And obviously we know the $7 billion plus that was spent there, but and we know the story, how it's idle right now. The recoveries were poor at Troilus, but what you have to understand, that was at the end of the life. The mine started in at 10,000 tons a day, and they were crushing to a mesh of about 75 microns, which happens to be exactly what we're going to crush to. And at 75 microns, they were getting recoveries in the mid-90s. Very, very good recoveries from 87 and from J. They then expanded, and this is important. Troilus was, and the opportunity for us adding 13 million ounces, I have always said it's not that InMed did bad work, it's InMed did no work. Their capital in the company went to every other asset except Troilus. So when they did get a bit of a spike in the gold price, they expanded the mine from 10 to 14,000 tons a day. What they did is they pushed more tons, but they never invested any money into the front end, so they went coarser. So they went to a coarser grind, and the coarser grind equated to decreased recoveries. If they would have kept it at 75 microns, they probably would have got the same. Then they pushed production further, and I forget what year it was, to 20,000 tons a day, and they went to an even coarser grind. And when they went coarser, the recoveries dropped again. So it was really a function not of the deposit giving the recoveries that they were hoped. It was a function of the fact that they didn't invest some money in the front end of the mill to facilitate continued recoveries like they started the mine with. And that's very well documented. And it's interesting. In the 5 years, this is the first time anybody's ever asked me that question. So congratulations. But no, you're absolutely right. So from our standpoint, every single ore type and zone has been identified and justified. And we've got the ultimate recoveries that we think are going to be very economic. But the history is really important in these brownfield sites to understand why certain things happened. And so it was really a function of pushing tons and not investing capital.
It's an interesting, that whole region is very interesting to me. Quebec as a whole is very interesting to me from a geology perspective as well. So maybe we can, I know we have to run here in 2 minutes, but maybe we can actually pick this up next time from a geology perspective, because it seems like you'd like talking about these things as well. But so far, it's been a good overview, Justin. I appreciate your time. What am I forgetting to ask you, though? What did you come here hoping to talk about that I'm failing to bring up?
No, you know what? I think you've got it all. I think at the end of the day, discussion of the feasibility and the market reaction. I really just want to get the point out that assets like Troilus are very rare, right? Size and scale to facilitate long life production that's generational. Secondly, the economics that we put out were based on absolute top of the market inflation, which we're seeing today. And as such, we believe are very, very justifiable and defendable. And that was our whole premise. And finally, these are the type of assets that are getting built. Low-grade bulk tonnage, long life assets, because of the immense leverage and the immense cash flow that they produce at scale. And you know, the storyline and history that Troilus is going through in real time right now has been replicated by a number of companies doing similar things, and that ultimately came out very well in the end. So anyway, really insightful questions. Thank you very much for that, and I look forward to talking to you about geology in the future.
Good. Well, thank you, Justin. I appreciate you investing so much time in me and going in depth on some of these things. It has been a pleasure. Enough of listening to my voice for now, though. I can imagine you're getting tired of that. So hopefully we can pick it up in the future. We didn't talk too much about the geology. I like looking at rocks. I like talking about rocks and learning more about them. So hopefully we can do a geology deep dive indeed in the future. But thank you so much for investing in time in me today. And I'll let you drop off now. You have a good day, because I have to go fly to Mexico. I'm flying to Mexico once again because I will be looking for silver once again. And I'm going to be hearing about it from Alberto Orozco, the CEO of Capitan Silver Corp. Capitan is listed as CAPT, so that'd be CAPT on the Ventures Exchange in Canada, where an average of about 35,000 shares trade each day, with a 52-week high of 24 cents and a 52-week low of 11 cents. With a market cap of about $13.5 million and about 84 million shares outstanding today, this is a 16-cent stock. There are no warrants, but there are 6.2 million options, leaving the number of fully diluted shares at about 90 million, with insiders holding about a quarter of the company at 22%. The last financial statement, which is dated March 31st, shows me $820,000 in current assets, most of which at the time, $700,000 to be specific, was in cash, and there's no long-term debt, but there is about $300,000 in account payables and accrued liabilities. It is worth noting, though, that the financial situation will be different by the time, or by now, actually, by the time of recording of this video, because since this financial statement was published, the company has, well, obviously, number one, being spending money, but they also raised some money as well. They raised $2 million at 15 cents, with the financing closing in mid-April. So to be reflected in the next quarterly financial filings, I suppose. Talking about spending money, that same financial statement from March also tells me that on average, over the last reported 6 months, Capitan recorded about $55,000 a month in administrative expenses, excluding share-based compensation, with management and consulting, as well as professional fees, making up the majority of that bureaucratic spend, if you want to call it that. Whereas exploration expenditures were published at around $125,000 per month on average over the last reported 3 months, with geological consulting making up the majority of that cost, as there was no drilling happening over the last reported 3 months. But again, that will also have changed by the next 3 months that are upcoming here, and you figure out why here in about a minute as we're going to be talking about it. So from a ratio perspective, this means that Capitan's total cost over that period was split in about a 70-30 fashion, with exploration being the 70 and administration being the 30%. As it always is, though, please understand that this is nothing but a snapshot in time, so it's not necessarily fully representative of how this company runs or will be running in the future. So please head over to the company's website as well as setterplus.ca to look at all the numbers yourself and make sure you're getting the full picture. For Capitan, that picture is specifically focused on silver, specifically focused on Mexico. As I said, they recently changed their name even from well, not that recent, over a year ago now, I suppose. They went from Capitan Mining to Capitan Silver to solely focus on that one metal. And it's more specifically the Cruz de Plata project in Mexico, specifically the Durango district. Not a huge property. It's only about 20 square kilometers, but this land is located in the historic mining district of Peñoles in the middle of Mexico's silver belt, really. And this same land package is the home of two historic silver mines, as well as an oxide gold target that we will talk about later on. Capitan drilled this project between 2021 and 2022, adding over 6,000 meters of drilling in that period, mostly focused on the Jesus Maria vein, with, as you would expect from the silver belt, very high grade intercepts of over a kilogram of silver in some of the highlights. But as you would also expect from this belt, relatively narrow intercepts of between 1.5 to 3 meters wide. This land package also has an open pit inferred resource already of 305,000 ounces of gold at about a half a gram per ton, as well as 15 million ounces of silver at about 62 grams per ton, which Capitan says remains open in all directions as well as at depth. Again, to be discussed later on. The total strike, by the way, now sits at around 1.3 kilometers, so 1,300 meters after the addition of some extra land most recently. And the company believes this could get to about 2 kilometers or over 2 kilometers, actually, which they say warrants further drilling and further exploration. That's not the only structure on the property, actually, that Capitan has identified with 8 different pieces of structures showing promising characteristics for gold and silver mineralization, of course. One of those structures is actually cross-cutting the Jesus Maria vein that I told you about earlier, so making the geology even more interesting about in that region. So we'll talk about that as well. So as it often is, all of this sounds very promising, but it oftentimes also leaves one question to begin with for me, and it's pertaining to the history of the project. And I suppose, Alberto, now on to you. Why hasn't someone else already gotten their hands on this property, and why do you think you're the chosen one?
Well, thank you, Antonio, first for having me. It's great to be here and be discussing Capitan Silver and Cruz de Plata. And it's great you start with that question because, you know, projects and exploration, you know, they're a tricky business. And oftentimes, you know, what happens is that the properties have these different cycles they go through. As you probably know, myself and our team in Capitan currently today, we work for Argonaut Gold. All of us together. Before that, a lot of us also with Pediment. And in that period, we went through probably most of the advanced projects in Mexico, particularly during the Argonaut phase, because we were focused on acquiring something that we saw the potential to expand quickly and put into production. And we brought this view into Capitan. This is why we decided to go and do Capitan, because when we came across this project, we thought that this really checks all the boxes for a project that could have scale, that could have grade, that could have the ability to be developed, that has the, let's say, the geography and the access, the community conditions there. So obviously you ask, well, how is it that nobody else got to this project before? This was actually in another company before, a prospect generator company called Riverside Resources. Riverside had a model of getting partners to develop the projects, and they actually did that. It was through those partners that they started developing the project. I, in fact, had looked at this project back in 2011, maybe a little, just in the early phases before they did the drilling. And we found it at that point to be really interesting. But what we were looking back then was something more advanced, more developed, that had a resource, or that you could see a resource being formed. And after Riverside, in that period between 2011 and 2015, with a couple of other partners, put 7,000 meters of drilling into the gold system and 3,000 meters of drilling into the silver, nobody was looking. This was the point in the market where everybody was cutting their budgets down. everybody was reducing exploration teams. We were all focusing in mine site exploration, in optimizing operations. And a lot of these exploration stories just went completely under the radar. I was really surprised having some conversations during an event. Somebody brought up this project. It used to be called the Peñoles project before, because the community right next to it is called Peñoles. And I said, yeah, I think that's a really interesting project, but I think it's at an early stage. And I said, well, have you noticed that it has 10,000 meters of drilling now? It has a starting resource. And I was surprised because I didn't know that, and went to look at it. And I was really excited at first because of the gold portion of the deposit. This is actually two projects in one. You have the gold portion of Capitan Hill, and then the high-grade veins of Jesus Maria. And I initially got excited about the gold because it looked very similar to what we had been doing at Argonaut at El Castillo and San Agustin, disseminated at surface oxide with great continuity of the mineralization. But then I look over to the silver, and we find that there's this great continuity of the veins, really consistent thickness in the intercepts that they had caught, and the silver became really, really interesting as well. But going back to the original question, so we were surprised to find this, and the reason was that it just went completely under the radar. Unfortunately for the companies operating it before us, they couldn't get the traction in the market at that point. The property ended up going back to Riverside, and that's when we decided to do something and spin it out and form Capitan Silver and use the experience that we have in Mexico and the team that we have been putting together in Mexico, previously with Argonaut and previously with Pediment, to come and develop this one asset that is probably the one that escaped everybody's attention and went under the radar, which became the opportunity for us in Capitan.
And the political situation doesn't seem to scare you there. What do you think? It's mostly arm waving, or what do you think about that right now?
Obviously, there's a lot of uncertainty, particularly when you are outside of Mexico, and you're looking at where to put your money. You have to remember too that Mexico during the previous cycle put a lot of, had a lot of exploration, put a lot of things into production. It's been there's been some modifications to the law. There's been some talk on mining every day. It's definitely not the same environment that we saw during the last cycle. But it's probably also a lot better than the general perception outside. The truth is also that some of the projects have been moving forward. Some of the bigger stories that we know recently have been moving forward in Mexico. I think there's probably this environment is going to continue for a little bit as the new presidency comes in and takes place. But I'm feeling very optimistic about the presidency of Sheinbaum. I think she is already showing that she's going to be a more balanced president, that her term is going to be very based on science. We've already started to see some of the people that are going to be in her cabinet and are seen favorably by the mining sector. So I think that the current government is definitely going to be demanding of the mining sector, but not beyond what we're seeing internationally. And I don't think in general that we disagree in the mining sector. We want to do things right. We want to be respectful to the environment. We want to consult communities. These are things that have been happening all over the world. Mexico has not been the exception. But perhaps things have slowed down a little bit to be more thorough in the review. So I think that companies that do things right, companies that are able to have a good relationship with their communities, companies that are able to show that you're going to have a project that has solid environmental foundation, are going to be able to get permitted. We'll see what happens with the legislation and more changes, but I think, as we've seen so far, that there are going to be workable, and that we're going to be able to continue to move projects forward.
I hope you're right. It's a big thing with Mexico right now. I try to ask everybody I talk to about it, or people who are operating in the country, and you live in Mexico yourself, so it's maybe a better idea to understand what's happening. And I want to talk about the different styles of mineralization on your project as well. I want to touch upon the gold. I want to touch upon all these things actually that you gave me there in the overview. Um, and maybe we can kick it off with the Jesus Maria vein, which is in your presentation. Actually, you start off by comparing that to how Vizsla got its start, and then later on we're also going to talk about another comparison that you make to Mag Silver, which is about a different part of the project. But given the limited amount of drilling that's been done on the property, what do you think it's appropriate to make that comparison already?
Well, there's a couple of reasons. One is we're also trying to point the attention of the investor to the opportunity. And obviously, Vizsla's Panuco project, which is a great project, by the way, it's one of the top stories in the world today, and it's in Mexico, had a beginning. And that beginning was in the Napoleon vein. And when you see that one slide that we have there in the presentation, we have a couple of those historical long sections that Vizsla had there. The first one on the top was the very first long section that they put out. And I think it was 100 meters of strike length that they've been showing there. And a year later, they had expanded it to about 1 kilometer. And what we're showing is that, we have those high grades. We have a similar set of results as has been shown in Panuco, but we already have 1.3 kilometers of strike length drilled into the Jesus Maria vein. So when you go back and see, obviously it was a much better market what Vizsla had when they were starting, but they were a much larger company than we are. And so at a point, I think by the time they had that second long section, they were over $300 million market cap. We have something very similar comparing Panuco, Napoleon, and our Jesus Maria vein in those points in time. And unfortunately, we haven't had the market, but it's a way to show, look, we have the geology, we have something that made another company win. We have been very disciplined. On top of having the geology, we have been very disciplined in forming a company that has been conservative with their share structure, that doesn't have any warrants, that has the team, has a great location. And we want to be that investment opportunity for the next cycle. And that's really what we're showing, that we already have the geology there. We have all the other elements. And we don't know how large it's going to get in the end. This is exploration. But where we're at today, it could be comparable to where the Napoleon vein was at that point as well. And when we,
no, go ahead.
And when we, sorry. We put that other slide with MAG. That was to illustrate a couple of really interesting things. One is, well, we not only have that polymetallic vein of Jesus Maria, which is showing great grades, great continuity as well, by the way, because not only do we have it drilled on a 1.3 kilometer strike length, the surface showings continue for over 2.5 kilometers. It could be longer if when we consider some of the showings go beyond our current property, but we control 2.5 kilometers. The average length of the vein that we see is 10 meters. It has a core of higher grade within it that is really nice, but it's really, really continuous grade. We're not talking of just very narrow structures. But crossing it at an angle, which could be a younger structure, is what we call the gully fault zone. And that zone is more gold dominated than silver. It's a broad zone at surface too, but it has some of the highest grades we've intersected in the project. And it's very similar to what MAG has at the other Valdecaña system, their polymetallic vein, which is then cross-cut by this silver, gold, mostly gold, broad zone with some high grades in it. And they actually have 2 or 3 of those that they have already identified. So one of the things that we say is, look, we have something similar to that geology in Valdecañas. We could have additional subparallel zones like that we have not yet intersected or found. But another thing that is really important to remind people of is that when you look at Valdecañas, certainly much more advanced than us today, but when you look at them and you look at Cruz de Plata, that system is 500 meters from surface vertically. Ours is right at surface. So at Cruz de Plata, you can go to the Jesus Maria vein, you can stand on it, you can put your finger on it, and you can see the sampling right on surface and how it continues on the surface expression. And when you consider that for developing and operating the project, the cost benefits are huge. When you're 500 meters from surface, and to be at surface, it's a tremendous advantage.
Again, lots to touch upon there, so I want to talk about all these things, but you've now expanded the strike length by 500 meters, as you touched upon, to a total of 1,300 meters. Not a small increase for you. Did any of that change your thesis on the geological controls on mineralization and how they influence your exploration strategy going forward?
No, not really. If anything, they confirmed our concept of the continuity of the Jesus Maria. These 5 holes extended at 500 meters to the east. They came with the new property that we acquired that connects what is called as really the historical mines of Jesus Maria to the west and San Rafael to the east. And this new property contains another historical mine right in the center of this whole structure as well. So when we looked at those 5 drill holes, they connect beautifully to the trend that we had already modeled with our drilling, and obviously to the surface expression there as well. So they actually confirm the thesis. We obviously have a lot more drilling to do after acquiring that piece of land and incorporating those 5 drill holes into the system and understanding what they meant. We also did a lot of surface work, very focused on that trend, on those 2.5 kilometers, to understand what else was there. And what we now understand is that on top of the Jesus Maria vein, properly the Jesus Maria vein, as we now understand it, there's at least 2 more to the north, subparallel zones that we have not yet drill tested, and that we have at some point to drill test. And additionally, there are other zones to the north. This new property that we got, it has an extension to the north, and we've been doing some mapping and sampling there. It appears like that there could be additional targets to the north, similar to the silver targets we have between Jesus Maria and San Rafael, that we could test later on. That's a project or a target that it's taking shape right now. But all that understanding, let's say it's new, it's more refined, it's part of what we've been doing lately at the project. So we understand now that it's not just the one vein of Jesus Maria, it's a system of subparallel veins, mostly polymetallic, but in some parts that are just gold and silver. It's a system that has several pulses of mineralization, as we're seeing with the Gauley Fault zone, the gold deposit as well. It's also a system that is showing us the deeper portion of the system so far in an intrusive that it's entering the property, and that has Jesus Maria on one side and the new silver anomalies that we're seeing to the north on the other side. And a little farther away from that on another external ring, the gold deposit, which is the lower temperature epithermal part of the system that is telling us that that's the top. And if that's the top, that's great news, because we have a lot of room to grow at depth. And we haven't really been exploring that much at depth. But we did have one particular hit in one of our drill holes as we were drilling the gold deposits. One of them went a little, we decided to take it a little deeper than the rest. It was hole 29, drilled in the Capitan Gold Zone. And we got a surprise, because that specific hole intersected the same style of mineralization that we're seeing over to the north at surface in Jesus Maria. So there was an intercept close to 300 meters of depth in an inclined hole, subvertical. Unfortunately, bottom in mineralization, we couldn't continue it further because it was a reverse circulation hole. But that opened up things greatly for the project. It was a 350 meter unintentional step out on what we're seeing at surface to the north, and telling us that underneath this gold system, which is the top of the system, there's a lot more to be found. And that'll be a campaign for later on. But basically what we're seeing is a big system. It's a big system with several pulses, with different let's say, temperature, depth elements in it. And what that tells you is that there's still a lot to find. There's still a lot to find in between one side, something that we're developing to be the next El Castillo or the next San Agustin with our gold deposit. And something on the other side that's comparing to, Vislas Panuco or Valdecañas, and where there's definitely a lot more to be found yet. We have done very little drilling, only 6,500 meters drilled or so in the silver part, only about 12,000 in the gold. That part is perhaps more developed because that's where we started the company. Our initial drill program was on the gold, as like you said, Capitan, mining before, not yet focused on the silver, because we made that decision initially because we had not yet acquired this middle piece that now we control and have consolidated the whole trend of silver. But we also had a royalty that we needed to consolidate before before going into the silver really and showing the high grade potential of these silver portions and buying the new prop. So again, just in a nutshell, a lot of potential. We believe this is just the beginning for Cruz de Plata, but what we see is already very, very significant. You mentioned the initial resource, 300,000 ounces for the gold, 15 million ounces for the silver. Based on very few drill holes, very close to surface. We've now expanded the gold. We haven't released yet a new resource estimate. The silver has been considerably expanded and has a lot of room to grow. But one note on the silver, because you also mentioned the average grade, which was at 60-something grams per ton silver. And it's really important to mention it because that resource estimate for the silver was done with an open pit in mind. And if you look at some of the visuals that we have there for that, you can see a small cone. And this was done by the previous operators. There might be a small cone, and the reason the grade comes down is because they take on a broader zone of the more disseminated anomaly around the veins. But we don't think that that's going to be the average grade of the veins going forward. That's going to be much more better represented by the high grade intercepts that we're showing in our drilling. But it's important to make that distinction because when I look at a project, one of the first things I do is go and look at the resource table, if there is one. We have one here, and when you look at that silver grade, well, it's not very exciting. But you have to understand it's a broad disseminated area right at surface that works well for a cone or a pit, but really that's not what we're going after. We're going for the high grade intercepts and the continuity of the veins, pretty much like they had been doing at Napoleon, Vislas, or some of the other silver projects.
Recent drilling here, and I'm not going to ignore the last part you said. I'll just touch upon it later on. But the recent drilling that you have going on here is indicating indeed that kind of complexity of the geology, which on one side it's good because it means a lot of stuff is happening, a lot of opportunities for those rocks to get mineralized in multiple mineralizing events. But so big part of the value that's being created for shareholders by Vizsla Silver was that they kind of figured it out quickly, right? They started working on it, started off as narrow veins, but then they kind of figure out where the large stuff is. They drilled that out. And before you can blink in a couple of years' time, they created a bunch of value for shareholders. Given the complexity that you're dealing with, again, good on one side, but maybe challenging on the other side, do you think it's going to be more challenging for you to follow in their footsteps from a timeline perspective?
Well, Vizsla had one great advantage, which was a much better market. Right? We unfortunately were born well during the pandemic in September 2020. I guess we still had a bit of a silver market back then, but we decided not to go with the silver right away because of what I just mentioned. We needed to consolidate the property. We didn't want to go and drill the high-grade silver if we wanted to buy the key component of the silver trend that we were missing, and we didn't want to buy that before consolidating a royalty that would have extended into that new property. So we had a lot of work to do in the beginning of the company, and unfortunately, we missed that market back then. But we were really disciplined. We were really disciplined about our approach. I mean, we could have been reckless and go right away and drill the silver. That we believe would have made probably a lot more expensive a new deal, maybe even impossible. We were disciplined. We decided to let's stick with the gold first, show that we have a lot more scale in this project. Let's keep our share structure as tight as possible. Let's not issue any warrants. Let's make sure that we keep our key team that has been successful here in the past together and working on developing the targets. And once we did all that, now we have a company that looks a lot more different than when we started. We've consolidated the project. We've contracted out all the royalties. We've already shown that the gold deposit has a lot more scale to it. We've already shown that the silver high-grade deposit has a lot more scale to it as well. Our current targeting has also shown that we have multiple targets that we still need to test. I think we have everything we need for the next market. So, and this is what we were trying to build, that next opportunity for the next market. Right now, the markets are challenging. It's hard to get the capital. We've been trying to focus on getting the most possible outcome from our surface crews there in the targeting and making sure that we understand the project even better and generate some new targets with really low cost, but being ready for that next leg up in the market where we can go and capitalize a project like this, which I think is definitely one of the best projects that I have seen in Mexico in my whole career.
Yeah. Yeah, that's fair to say. And I want to talk about more specifically what's been coming out of the ground for you there, because I'm talking about that recent drilling that's kind of helping you better understand the package. You're also coming up with these high-grade shoots at Jesus Maria. What do you think is causing those, and how predictable do you think they're going to be for future drilling?
Well, the high-grade shoots occur in any vein deposit that you see. It doesn't matter which one you pick. You could pick one of the ones we've been talking about. You could pick Silvercrest, Mag, Vizsla. It doesn't matter which one. If you look at a long section, you're going to have higher grade shoots in some parts. It's just the way that the geology works and that vein systems work. So all we have to do is drill. It needs to be a drilling exercise so that we find the most out of those high grade shoots and just continue to expand on the vein. We know that there are going to be more, as happens in these systems, but you need to drill to get to them. I'll go back to one point I made earlier, though, as well, that the continuity of this vein is really, really impressive. In a lot of these systems, you see maybe meter or sub-meter intercepts, and that's it. You're outside of the vein, outside of that, sometimes a little wider. This is very consistently 10 meters wide. Yeah, you may have lower grade in some parts. You have these super high grade shoots in some others, but you can see the vein. You've hit it. It's going to be there. The continuity has been proven already over this 1.3 kilometer strike length, and it continues going. And that's really exciting because it's been a very predictable structure, to put it in another way. There are other structures we need to test that we haven't tested. We need to test further the Gully fault zone. We need to see if there are additional zones like the Gully that may be subparallel to it, just like in Max Silver's Valdecañas. There's a lot to do, but it's all centered in this one initial vein that is very consistent on strike, very consistent in its thickness. And there are grade shoots or high grade shoots like in any other silver system, but not every vein is as consistently continuous as this one.
What would following it up then look like, and specifically integrating that knowledge of those high grade shoots being there? Well, there's nothing you can do about them. I mean, they're out there, but how do you bring them into your exploration strategy? And specifically, how do you follow this drilling up?
Well, it's hard to. There's no recipe to follow when you're exploring this. You really have to start stepping out on your structure. As you have success with drilling, you continue to intersect. You're going to fill in some of the spaces. And you may hit some of the high grades in your expansion step outs, or you may hit it in your infill hits. You never know. It's hard to know. There's really no recipe, no geophysics that you could use that are really going to tell you where the high grade is. It's just a drilling exercise. But when you have a target that is as solid as this one, and you've already confirmed that these high grade shoots exist already in at least half of it, you know you're going to hit more. It's just a matter of knowing exactly where, and for that you need to turn on the drill rig and start drilling.
But so you're not going to do geophysics before that?
We might do. We're actually considering something. We haven't announced anything yet, but our crew is looking at what else we could do, because so far we've been talking about these 2.5-kilometer high-grade trend of silver and the gold zone. We have additional ground to the south. It's actually really interesting. We're looking at it as well because we now understand this to be a much broader system, and in fact, a large district that includes other deposits, as far north, well, not that far really, as the Mapimi mine further to the northeast, and other projects and historical mines that are in the area that are showing us that this is a much larger story than just this one project. It's a district, and within that district we have different systems. This is one of them, and we need to understand what else is within that system. So I think we've already done a pretty good job of understanding what we have at the core of it. And this one part to the south, particularly southeast, we haven't put that much effort into it. We have the crews looking at it right now. And we want to generate further targets there. Well, always, of course, looking at possible ways to consolidate further land. So that's something we're looking at continuously. And that's part of what our crew is also doing in the field.
I suppose one, and I actually do suppose, because I don't know this to be true, but I suppose one obvious target could be just drill a deep hole between Santa Teresa and Jesus Maria to see if there's two connect. Is that part of the plan for you?
Yeah, some deep drilling is definitely in the plans for the future. I think if you look at our long section that has the 2.5-kilometer trend all the way from the Jesus Maria mine to San Rafael, the most obvious target is a shallow target. It's connecting the dots between our 1.3-kilometer trend and some of the anomalies that we found to the east, and started to expand the vein in that direction. But at depth, we haven't really gone that far. I think vertically, we're probably talking about maybe 200 meters at the most, mostly around 150, 175 meters of vertical depth that we have tested. And this is an intermediate sulfidation system. These systems tend to have a lot of vertical continuity. So on the vein itself, on that same long section that I was just talking about, there's a lot of room to grow at depth. But then you have also to think about the top of the system over at the gold deposit right next to that. The fact that we've already hit some of the silver mineralization just underneath that. And I think some deep holes would be really interesting right underneath that part of the deposit, where you have probably a more complete cross section from the epithermal part all the way down to what's underneath. We haven't yet found the feeder zones for the gold. That's another target that we're looking for. But we're already getting at least one hit underneath the gold deposit that tells us that the silver veins continue underneath, or there are more to be found. So that's a deep target that I think is really, really interesting. On top of others, there's one that we've been discussing pretty much since the beginning of the project, but probably becoming more interesting now. And maybe geophysics would be really interesting for that one, is a skarn target. I mentioned earlier that there's an intrusive more or less at the center of this whole system. And right at the contact of that intrusive and the sedimentary rocks where Jesus Maria is hosted, there's a zone of contact metamorphism. and there could be a package of more calcareous rocks in probably a depth within the project that could have hosted a skarn, more of a skarn target. Projects like La Colorada in Zacatecas, which is very similar to this one as well, have such large skarn targets, or in that case, a deposit, that are also an interesting target here. So at depth, there are multiple targets that we would like to test. But we have a very, let's say, a short-term target that is filling in or continuing to expand that long section over the 2.5 kilometer trend. So expanding it from 1.3 and drill testing it on the remaining kilometers. After we've done that and we've identified where the zones of high grade are, or the ore shoots, we want to also expand it at depth. And that's just the target that we can very easily see and go stand on. We know that this is a bigger system, and that the deeper targets are going to be really, really interesting as well.
But I do want to talk about the skarn. I hope we'll touch upon that as well. But it is connecting Santa Teresa and Jesus Maria a plan of a goal of yours, a plan of yours, a dream of yours?
Yeah, absolutely. That's one of the goals that are more short term, connecting all that trend, expanding from that one. Well, we were 800 meters. We expanded it to 1.3. We are seeing all the surface expression over 2.5 kilometers. That's our main target in the short term, expanding that trend of high-grade veins, finding additional high-grade shoots. And as we do that, then we later want to go and expand it at depth also. These other targets that I'm discussing, they're also very interesting, but they're not going to be our short-term focus in the project.
They're interesting, though. I mean, the skarn, and this is where we can talk about that, because I'm not a geologist at all. The first thing from a geologist we talk to today, but what caught my eye is that you're dealing with garnet and pyroxene in the skarn stuff that you were coming up with. What's your thesis on how those got formed, and can that also be followed up to the new part of the property? And so, multifaceted question, but those are the questions that I was coming up with. And so like, how does that even fit within your whole thesis for the region?
Well, it's all, like I said, it's a system with multiple pulses, and it all seems to be centered around this intrusive that is very fluid rich. When you look at it, there's a lot of it has a lot of these big biotite books, which tells you there's a lot of fluid that was coming from that intrusive. That's probably what was driving the system, particularly in the beginning, that caused the metamorphism with the sedimentary rocks that were around there. Maybe that was driving the system of the high-grade silver. There may have been a newer pulse with the gold. I think at this point, with what we know today, that maybe the Gully Fault and the Capitan disseminated gold zone are probably part of a similar pulse. And there, let's say the lower temperature part at Capitan with the gold, and the higher temperature portion in Jesus Maria in the intermediate sulfidation part and the epithermal part. There's a really interesting target in between of temperature, where in a lot of deposits in Mexico, that tends to be the most productive horizon, and that hasn't been found yet here. Yet what we've already found is really, really interesting. So when we look at it as a system, we believe that, one, we have a very complete system. It doesn't seem like there's a whole lot of erosion that has happened in it, and we see that very well represented by the top part of the system with the gold part. With those multiple pulses that are represented by very clear things, like Jesus Maria being cross-cut by the Gully Fault zone and then being overlain by the gold deposit. And when you look at all that as a whole, and we've been understanding this as we've started working in the project in 2020, the more we see it, the more we zoom out and look at it as a system. Obviously, when we started, it was all about expanding the gold zone and looking to see how much we could expand the silver. But as we now consolidated the system, started to see that there's this intrusive is important, that there's more mineralization to the north. We zoom out a little bit, not only on surface, but at depth as well. And I think in the long term, it has a lot of implications, because we will want to test a lot of targets. It's a rich system. It's not something you find every day. It's a rich system, very complete. In the short term, like I mentioned before, you want to drill what you already have found, and you want to see how large that resource is going to get. If we had 15 million ounces on only 3,000 meters of drilling, very close to surface, some of those holes not even 100 meters deep, what could we have now that we have consolidated a 2.5 kilometer trend that outcrops, that has multiple high-grade shoots in it already identified, and it's just sitting there. It just needs the drilling. It'll be interesting to see also how large the gold deposit gets, just with what we have added. But going back to your question, after we've done that, the project is asking for what else is there. And you zoom out and you see more. You zoom out and you see that silver intercept underneath the gold deposit. You zoom out and you see those zones to the north that seem to be mirroring what we're seeing in Jesus Maria, very early stage still, but that's what we're seeing to the north. You zoom out a little bit more, and now the property to the south that we have becomes more interesting, because it's now asking, well, what other part of a system could be there? This is really a larger system. And these are questions that we are still answering. But I guess one of the most important things here is, as we've done more work, we've become more excited about the project rather than less. Right? As we've done more drilling, we've continued to expand the project rather than kill it. And that's what you want, because you could kill a project by drilling it too. You can discover that it's not there. In this case, every single hole has hit. Not all of them have been super high grades, but every single hole has hit the vein or has hit the disseminated gold deposit. So it's very continuous, very predictable, at least what we can see so far. And yeah, there's a lot more mystery to it later down the road. I think it has the makings, it has all the geology for a much, much larger deposit. And that makes it really interesting too as an investment opportunity, because you already have some certainty. You have this small resource that was done with very little drilling. You are already seeing how that is growing by the drilling we did with the gold and the expansion we've been doing with the silver. But it's not over. There's more to be found, more to be discovered, and that gives you more upside when you're looking for a company to invest in. Multiple targets on surface at depth, and trying to consolidate more of this system as we work in it.
What is it going to look like for you more specifically doing that work? If you had to take it from a chronological standpoint, where do you start first? When do you start? And how do you take it? Like, what are the steps that you're going to take from there on?
Well, obviously we have a lot of drilling to do. At some point, we will have to do a large program. Right now, I don't think it's the time to do it, because the market is not there. But you definitely want to have a large program that really tests the extents of this project. And at some point, you're going to find its limits. No system goes forever. Or you decide that it's a good enough point that you could put out a resource estimate. What we wouldn't want to do is put a premature resource estimate out right now. That's what we believe happened with the first resource estimate. They had little drilling, but the company thought maybe that they could get some value for that resource. They didn't, unfortunately. The market wasn't there. And so they put out a small resource that now it kind of affects us. It gives us some tailwinds and some headwinds. Some headwinds because it's a relatively small deposit. Gold equivalent terms, close to 500,000 ounces. Not that small, but maybe for the overall market still is. But some advantage too, because now investors can see, okay, if that little with that little drilling, this size of a resource was found. How much larger can it get? And they can already see how it's grown in the gold, how it's grown in the silver, what we have consolidated, and how large it can get. So we don't want to put out a resource estimate without making sure that at least we've tested out a significant part of the deposit. If it's still going and there's no foreseeable end for it, maybe you want to put out a resource at that point too. That could happen as well. But we definitely don't want to be too premature. We could put something out right now with what we've expanded, but we see it's completely open on strike and at depth. It's going to get much larger, so we don't see a point. But obviously, the normal transition of projects is you put the drilling, you start to expand that footprint of mineralization. Eventually, at some point, you decide it's time to put out a resource, and then you typically move to a PEA there. So, we just need to wait for the right time to do a significant enough drill program here to show the true scale potential of Cruz de Plata.
What is significant? Like, how much drilling do you want to have into this before you come up with an updated MRE?
Well, that's a very tough question because obviously the results guide how much drilling you're going to put into it. When you look at some of the examples that we were just mentioning, they got to drill up to 100,000 meters per year at some point. I think a reasonable drill program, can be maybe between around 30,000 meters. That can really start to show a lot of scale. But if it keeps going, you'll want to drill a lot more, right? So it's hard to say how much you will want to drill, but I don't think you want to do a 1,000, 2,000 meter drill program that is not going to get you anywhere. You want to do something that gives you a good set of results that are going to show without any doubt that this is continuing on its length on strike and a depth. And that you're finding more high-grade shoots. And for that, you need more holes. Right? The more holes that you drill, the higher your chances of success and maintaining a good momentum in your story. So you just don't want to be too small.
When does that drilling start, though?
Hard to say. We need to wait for the market right now. Our share price, even though it hasn't been hit as hard as some other companies, I think it's still our access to capital is quite expensive. So right now we're happy to continue to put some of that surface and further targeting work on it. We're considering some geophysics to put some additional targets in the project and to consider additional consolidation opportunities. So I think for the short term, we're not going to see any drilling, but we're going to continue to add value to the project.
Okay, short term. So market dependent. Like, you cannot tell me, okay, I'm drilling in 16 months or anything like that.
Yeah. Hard to say. This year is going to be tough, I think.
Okay, but then how much money do you have right now in the bank again?
I'll get back to you on the exact amount, but we just raised 2 million recently. So.
And then you had some.
We funded for this year and part of the next.
That's okay, but then you don't have to go back to the market at this valuation. That's kind of your goal, I assume, is not to have to go back to the market at this valuation.
No, at this valuation, we don't really need to go back. We're funded. Obviously, we start drilling that consumes a lot of your cash very quickly, and we want to be conservative in this current market.
Okay. And so what then are you doing this year outside of preserving G&A? Like, what kind of work are you going to be doing?
We're going to continue looking at the surface expression of these structures. We want to do more targeting. We're evaluating also ways of creating further targets that are not too costly, that are very cost efficient. And that's why where geophysics are coming in, where we're considering doing something not only in our core area, but also to the south in the property that we also have, that we haven't talked about at all in our recent press releases or materials, but it's there and it's interesting and it's part of understanding the system. I guess we want to understand this more completely as a system and really be able to show what the potential for the full scale of the project is. We've been very focused, and it's very meaningful. We've been very focused on the high-grade silver structures and those 2.5 kilometers of trend. There's definitely much more to do there. But right now, with a low, very cost efficiently, we want to look at the rest of the project and see what else is there in that in this system. What else is there is geologically? What other targets we can come up with that are not going to break the bank, but we're going to continue to add value to the project.
Good. Well, Alberto, I'm starting to get a better idea of how you want to operate this company. It might be worth revisiting this when you eventually have a drill plan in place, when you're doing more capital raises and stuff like that. But it's been a good overview. What am I forgetting to ask you, though? What did you come here hoping to talk about that I'm failing to bring up?
No, I think it's been a pretty in-depth chat. I'll just wrap it up by saying again that I think we built a really interesting company for investors to come into. We've been very disciplined in our approach, trying to keep it low cost, tight share structure, no warrants, and consolidating this project efficiently as well, consolidating the trend, consolidating the royalties, to have the right vehicle with a team that has done it before, developed 4 other projects in Mexico in the past. We're ready. We're ready and set. One thing maybe I would mention that not a lot of people know, and particularly outside of Mexico, is that I am the president of the Sonora mining cluster here in Mexico, and that's very relevant with Sonora being the largest mining state. All the opportunities that gives us to understand about what's happening in Mexico, where things are going, and I feel that we're going to continue to have the capacity to move things forward based on that exposure and that view that I have from Mexico overall. So in summary, I think we have a great opportunity in Capitan Silver. If anybody's looking for silver, I think this is the place to go, for a company that has a lot of room to grow. Our market cap is still small, but we have all the elements to be a much, much larger story.